for many investors, there aren't that many alternatives to the U.S. market.
There has been so much complacency within the market.
There are going to be pullbacks. Those could be buying opportunities.
Markets are just still so focused on AI is great for the long term.
This market is really going to get its mojo going forward from earnings.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, tension rebuilds. China and the US positioning for negotiations later this month as Fed Chair Jay Powell gears up to reveal his thoughts on the economy. JPMorgan is kicking off quarterly earnings season on Wall Street. Those numbers about 45 minutes away.
Can good news from corporate America overwhelm some of the geopolitical jitters that continue to mount overseas? This is a real question here. JPMorgan might not be indicative of the rest of earnings season. Nonetheless, people are highly attuned to any kind of volatility, any kind of downside surprise, any kind of mediocre surprise in any of the corporate earnings that do kick off in earnest this week.
JPMorgan kicking off things later this hour. Next hour, numbers from Goldman Sachs. This hour right now, equities pulling back by 0.9% on the S&P 500. Tension between the US and China in focus. Last week, it was about flexing over refining capacity of rare earths. This week, it seems to be about shipping.
It is about shipping. Today, China sanctioned the U.S. units of a South Korean shipping giant. This comes after what's going on with rare earths last week. What you see is both Beijing and Washington lining up the bargaining chips and the leverage they can use at the end of the month when President Trump and Xi Jinping sit down. Even more importantly is going to be when Scott Bessent, the Treasury Secretary, sits down with his counterpart, because he had some hot rhetoric in the Financial Times today when it comes to China, saying that this is a sign of how weak their economy is. They want to pull everyone else down with them.
And this is the problem, I think, for investors right now. Is this just positioning for negotiations later this month, finding some leverage, pockets of leverage, or is this the real deal? A sign of things to come?
Right now, the market's treating it as simply trying to get leverage. This is not a capitulation on the risk on trade. I think a lot of people saw that yesterday when we saw the huge swelling to buy the dip, when we saw conciliatory language out of President Trump. I keep thinking about what Pete Shear said yesterday at the Academy. It feels different. And this morning, I was thinking the fact that China did not offer up the same type of conciliatory language that we got from President Trump, that tells you something. It feels like maybe there is a slightly different tinge to this round of tit for tat.
It does feel different for me as well, because when you read through more of what the Financial Times is reporting, a senior U.S. official told the FT that the timing of what China did was so surprising because it was disproportionate to what they were expecting. So if this is fact and the U.S. official is on background talking to the Financial Times saying that this was not what we were expecting, then that means that the rhetoric is certainly amped up going into the year end.
There's a bit of a tell in the bond market, by the way. That rally from Friday, it holds, it sticks. Yields are threatening to break below 4% on a 10-year maturity this morning. We're down 3. That line in the sand, we're right on top of it right now, 4% on 10-year bond yields.
People are more worried about weakness than they have been. They're worried about the blowback, the disinflationary aspect of the tit for tat, especially in lieu of what happened in April 2nd. That, to me, is a very different feel. Jean Bovin of BlackRock yesterday said long term, we could still see that inflation. That could be a concern. But near term, we could get a reprieve. And this is a perverse way of putting it, but we all understand that. A reprieve from the idea that the economy is slowing enough to give a bid to the bond market so you don't see those runaway yields. Not necessarily something that's screaming all clear for people to pile in, but nonetheless a tactical trade that a number of people are getting behind.
The stock's down, bonds up. Bond yields are lower this morning. We're down by 3 basis points on 10s, 4%. A break at 350 on 2s, 347 so far this morning. Coming up this hour, Keith Lerner of Truist with stocks whipsawed by trade tensions. Elyas Galou of Bank of America as fund managers see risks of a bubble. And Gerard Cassidy of RBC Capital Markets as big bank earnings kick off later this hour. We begin this hour with stock sliding as investors count down to the start of earnings season. Keith Lerner of Truist writing the following. The current bull market likely still has further upside, underscoring the importance of staying focused on the broader trajectory rather than short-term turbulence. Keith joins us now for more. Keith, welcome to the program. Are you expecting some short-term turbulence this earnings season?
Yeah, well, first, great to be with you. I think it may be a little bit of a spookier October. We didn't get the seasonal weakness that a lot of folks were looking for in August and September. And as you just discussed, like we have this big meeting, it's at the end of the month. The Fed's meeting's at the end of the month. I think earnings continue to be the North Star, but I will say heading into the earnings season, and we've had just one of the strongest 6-month rallies we've seen in history. Expectations are somewhat high. You did see some complacency, put the call ratios were really low going into this as well. And as I look at the overall market, you're just seeing some minor cracks. So I just think this month is going to be a bit more turbulence. We still think we're in a bull market that deserves the benefit of the doubt. But, I think this turbulence is likely to continue through this month.
Keith, Annmarie and Lisa were talking about the tension between the US and China somehow feeling somewhat different going into negotiations at the end of this month. And I think you can see that in the price action. Yesterday's bounce smaller than Friday's sell-off, and the sell-off resumes again this morning. Keith, is there something different about things this time around?
Well, I think the biggest challenge from a market perspective is just that you're going into this with higher expectations. You're at a 22 multiple. As I mentioned, you've had this big run. So you just have, you're more vulnerable to bad news. Whether this actually from a political side is different, we just don't know yet. I mean, that's just the reality. We don't know. I think what we've seen over the last, 6 months is that when we start to have more tension in the markets, eventually, cooler heads prevail. But as just mentioned, we just made new highs in the market. So the question becomes, how much of a move down do we need before we start to see kind of a backup? And we're only a few percent from all-time highs. So I suspect that we actually still have some more work to move on the downside before investors start to focus back on what we think is the North Star of this bull market, which is still earnings.
So, Keith, this isn't a buyable dip yet for you. Is that correct?
This is not a place yet where I would say I would be aggressively buying here. No, I think, if we look back historically, we haven't had even a 5% pullback since April. We often talk about pullbacks are the admission price to the market to eventually higher prices. So, we're a few percent from an all-time highs with these kind of a little bit of a cracks. I'd like a little bit deeper of a pullback, and I'm not saying 15%. I think something in the 5 to 10% range would be something where we would say potentially be more aggressive.
I wonder what your read-through is going to be from the bank earnings that do kick off shortly. We are expecting, based on what Jefferies reported a while ago, this boom in M&A, this idea that there's more corporate confidence. We're seeing that in surveys. Does that do enough to alleviate concerns elsewhere and make you have conviction to buy in a more broad-based manner?
Yeah, well, I do think it's important. I think, we're all looking at whatever economic data that we have, and there's certainly some divergences between, like, say, Atlanta GDP, which is well above 3%, and the softening in the labor market. And it's really about what are the banks seeing? What are we seeing on credit? What are we seeing on lending? In our view, what we're seeing is still this kind of two-speed economy where the high end is doing well and there's more challenges, especially at the low end. So I want to see if that continues. We did get Delta last week, which was encouraging, talking about, an upgrade to their view based on the high-end consumer. So I suspect that continues, but I think it is important. And to be frank, we're not selling here. We're sticking with the underlying trend. But if for us to add more to risk at this point, we would prefer at least a little bit of a further pullback or more of a consolidation in time where you kind of chop around and kind of reduce these expectations. This morning, the BofA fund survey came out, and we saw that sentiment or allocations are the highest since February of this year. That was prior to the setback, which was exacerbated by the tariff uncertainty.
Keith, when you're looking for a catalyst to look at what could potentially be a pullback in the market to then buy more, is it going to be this month as the tensions ratchet up between Washington and Beijing?
I think it could be. And the other thing I've been looking for, listen, I expect to have a good earnings season. One thing, as I mentioned, the North Star of this bull market has been earnings. So I'll be really interested to see how stocks react to good earnings. Last quarter, we went into the earnings season and expectations were really low. There was a lot of uncertainty around tariffs. What's interesting about heading into this earnings season is analysts have been raising their estimates into the earnings season. That's highly unusual. The last time we saw that was for the Q4 2021. So that just also means we have higher expectations. And then it also comes down later on will come down to tech. Tech's the big part of this market. We're still bullish on tech longer term. We still think the dominant theme is tech. But, I want to see how stocks react to good news, because I certainly think we'll have a decent earnings season overall.
So, Keith, we have seen these pockets of credit stress. I think we should explore as well. First Brands, Tricolor, tricolour. Have we decided which one it is, Bramo? Tricolour? Tricolor?
It's tricolor. If you go south of the border, it's tricolor.
Okay.
I think that's sort of endemic.
We've cleaned that up.
Thank you. That's great.
So, Keith, we've seen those pockets of credit stress, whatever Lisa said, and First Brands as well. Keith, do you think that's a private market issue and the public markets are insulated from what's happening there, particularly financial institutions? How are you and the team thinking about that situation?
For the most part, we do think it's idiosyncratic, but we have to keep an open mind. We have seen credit spreads over the last week or so really kind of rise for the first time in a while. We all know that credit spreads are at the lowest in some areas since the 90s. And, Friday, in our view, as a portfolio manager, was a good stress test for us to see, does diversification still work? I mean, we've got some questions for people. Why don't I own only tech, or why do I own any bonds? And what we saw, especially on Friday, is a good stress test. We saw high quality bonds do well, outperform. We saw gold outperform, and then we saw crypto actually underperform. So basic diversification works again. I am paying attention to the credit markets. We have seen spreads move up, not in an alarming way, but something we should at least pay attention to.
Keith, you mentioned the Bank of America fund manager survey, and in that survey, it showed that 57% of all respondents thought that private credit, private equity is the latest source or the greatest source of any kind of systemic risk or systemic credit event in the near future. That is the most conviction that we've seen in terms of a potential catalyst going back to 2022. Do you agree with that? Is that where you're looking for potential catalyst for some sort of disruption?
Well, a lot of times the issues in the overall equity market begin with the credit market. So is that the most concerning thing? I don't know. As I think about more of the public markets, we have a lot of companies that have term debt. They have big cash balances. Earnings have been relatively positive. So I don't know that we have a big credit event unfolding here, but we all do know that there's been a huge amount of money into these private markets. They're more opaque. And I think that's something that could kind of creep up more on investors, because it's just we have less information there. Think about it, we have less information on the overall economy right now without some of these these economic reports or government reports. So in the private credit markets, you just have less information. So when things start to unravel a little bit, you have less information to understand more broadly what's happening. But again, as I think about more the public markets, it's not something that at this point we really see as a systemic issue.
Hey, Keith, appreciate it. Thanks for jumping on. Keith Lerner of Truist. Big morning coming right up. It looks a little something like this. In about 30 minutes' time, around the 6:45 mark Eastern time, we should have numbers from JPMorgan. Later on this morning, 7:30, we should have numbers from Goldman Sachs. This afternoon, look out for this at 12:20 Eastern time. Chairman Powell addressing the economy. We'll have full coverage of that on Bloomberg TV and on Bloomberg Radio a little bit later. The Fund Manager Survey of Bank of America came up a few times in the last 10 minutes. Some of the numbers in that. Number one tail risk, AI bubble. A record 60% say global stocks are overvalued. At
the same time, you see cash allocations at the lowest levels going back to December of 2024 and really close to the trigger of 3.8% that could get people a little bit nervous about an overwhelming bullish take. So, yes, concerned about that overvaluation, but also concerned about missing out.
We'll talk to Bank of America in about 5 minutes' time on that survey. This morning, equity futures pulling back by around 0.9% on the S&P. We're down by more than 1% on the Nasdaq. With an update on news worldwide, with your Bloomberg brief, here's Lizzie Burden. Hey, Lizzie.
Hey, John. BlackRock took in $205 billion worth of client money in the third quarter, the world's largest fund manager expanding its footprint in private credit and in alternative assets as well. Investors also added $153 billion on a net basis to ETFs, which topped $5 trillion for the first time. Elsewhere, China has placed sanctions on US units of a South Korean shipping giant and has threatened further retaliatory measures on the industry. It's the latest in a series of tit-for-tat trade escalations between the two countries. Still, China's Ministry of Commerce said that the door remains open to talks, with officials set to speak later this week. And Broadcom shares are lower after the chipmaker became the latest to forge a blockbuster deal with OpenAI for data centers. OpenAI agreed to buy custom chips and networking components from Broadcom to help power AI services, with plans to spend tens of billions of dollars more on Broadcom chips in the future. It follows similar agreements from fellow chipmakers NVIDIA and AMD. And that should be my brief, John.
Another massive move for another chipmaker. Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, AI bubble territory.
We're getting into bubble territory for sure. If this whole AI thing turns out to be a lot of hype, that's not exactly the end of the world. It's not like 1999.
Up next on the program, we'll catch up with Elyas Galou of Bank of America as he breaks down the fund manager survey from New York City this morning. Good morning. Got a really busy morning coming up, quite a 24 hours for you. Happening later on this morning, in about 25-30 minutes from now. Should get numbers from JPMorgan. Later on next hour, numbers from Goldman Sachs. You'll hear from Citi as well. This afternoon, you'll hear from Chairman Powell. 12:20 Eastern Time. All of that to set up your Tuesday, heading into Wednesday when you get a ton more earnings from the big banks on Wall Street. Bank of America and Morgan Stanley. Plus another read on the airlines. United just around the corner. The setup this morning, really defensive, so check out the equity market. Equity futures down across the board by 1% on the S&P, off by 1.2 on the Nasdaq 100, and super defensive in fixed income too. 2s, 10s, 30s, bond yields down across the board. 10s threatening to break through 4. We're looking at the prospect of a 3 handle here. We're down by 3 basis points on the session.
People don't seem particularly concerned about inflation. They don't particularly seem concerned about the U.S. losing its haven status. And I've seen so many notes over the past couple of weeks sort of debunking this idea of the dollar and of U.S. government debt losing their status as safe haven. Two things can be the truth at the same time. They can be less of a safe haven. They would have been rallying more. At the same time, it clearly is the risk-off feel that is vindicating the appeal of government debt as that place for people to park their cash.
So there's your 3 handle, 399 on 10 so far this morning. More on the bond market later this hour. Under surveillance this morning, entering bubble territory.
We're getting into bubble territory for sure. If this whole AI thing turns out to be a lot of hype, it's not exactly the end of the world. It's not like 1999.
Here's the latest this morning. Bank of America out with its October Global Fund Manager Survey showing for the first time investors consider the AI bubble as the biggest tail risk. Joining us now to discuss, Elyas Galou of Bank of America. Elyas, welcome to the program, sir. Just going through some of these numbers, these stats, stock allocation, 8-month highs, a record 60% say global stocks are overvalued. The number one tail risk is the bubble in AI. Elyas, do you see those data points as enough to constrain this bull market?
Look, John, clearly the overall FMS sentiment is nearing full bull territory. However, I would highlight that we're not quite at close your eyes and sell level, because there are a few metrics that would temper the full bull sentiment, in particular the fact that there are still more FMS participants who think the global economy will weaken in the next 12 months rather than will strengthen. Also, when you look at the allocation to US equities, that is the center of the AI story, the allocation today is neutral. Investors have trimmed their underweight on US equities over the past few months. They are now neutral on the biggest stock market in the world. And that is why we continue to say that sentiment and positioning are less and less of a tailwind to global risk assets, but it's not yet the big headwind it was at the beginning of the year.
Elyas, could you say the same thing about gold? What's curious about this moment is that we've got all this to say on the equity market, valuations extended, bubble territory, all of that, and then you've got gold as the most crowded trade. What's the relationship between the two?
Look, clearly what's unique about 2025 is that you see several asset classes that are hitting all-time high at the same time. Gold, equities, credit spreads as of the end of September had hit a historical lows if you adjust for the balance sheet of US corporates. And at the same time, Bitcoin as well had hit all-time high earlier in the year. Clearly, what's happening today is that investors are trading long-term secular themes. They're trading AI. To do that, they are taking an exposure via the equity market. And that is why they keep buying despite the perception that global equity market are overvalued, just hit a new record high this month. But at the same time, they are hedging the new themes on Fed independence, the new theme that inflation is just not going to go back to the target of 2% via gold. What's very bullish about gold, which we capture now with the FMS survey, is that gold allocation for institutional investors is very low. The weighted average gold allocation is 2.4%. It has not increased since September. It's stable since August, and that is why we think the gold rally has further to run. Although in the short term, the price velocity, the fact that gold is trading 25% above its 200-day moving average, means that there is a risk of a short-term consolidation.
Which you would recommend that people buy, since you see gold going to $5,000 now. It's by the end of next year. I am curious whether we get the same kind of read-through from cash allocations that we have in the past, given the fact that there is this gold offset, that maybe cash doesn't serve as the same type of safety as it has in the past at a time of real questions around debasement of fiat currency.
Absolutely. Look, it's a great point. I think what's very important to consider here is the relative allocation to cash, but also the outstanding cash holdings. If you look at the FMS survey, it does show that cash allocation have dipped below a very important threshold that is 4%. It's now at 3.8%. It's remained under 4% for the past few months, and yet risk assets have rallied over the same period. On the other side, what we see in terms of global cash holdings, they are pretty much at record high. If you just look at the money market fund assets in the US, they've hit a record high of 7.3, 7.4 trillion. So yes, exposure to cash is low. In fact, FMS investors say they are underweight cash by the most since December, but the holdings of cash remain quite high still, and that is giving investors enough confidence that they can continue to add in terms of their risk asset exposure.
Which raises this question, if people really are this bullish, why are they so concerned about private credit and private equity? This to me stood out of the whole survey, the idea that 57% of respondents see private equity and private credit as the most likely source of a systemic credit event. It is completely different than even last month. What's triggering this? Do you see validity here?
Yes, it's maybe the strikest reversal that we've seen in this month's survey. We've been asking this question on the most likely source of a global credit systemic event since 2022. And what was striking this month is that we recorded the biggest conviction on the unique source of a credit event, in the sense that almost 60% said it was private equity and private credit. Look, the reason is very simple. The investors just look at the latest development in the auto consumer subprime market over the past few months, the default wave that have engulfed Tricolor, First Brands, and they also see the linkages between the private credit market and the financial system. You know, there have been a few news that several institutions were exposed to these default waves, and that is spooking investors. When they see that credit valuations are maybe just as exuberant as AI stocks are, and that is why they are now a bit more cautious on this side of the story.
The most bullish survey since February. Elyas, thanks for breaking it down. Elyas Galou there of Bank of America. So strange to see KKR down on the year by close to 20%. At the same time, Goldman Sachs is up by close to 40%. We'll dig into Goldman later this morning. Those numbers about 60 minutes away. Let's turn to GM. In the pre-market, this headline for you, seeing a $1.6 billion charge on EV production realignment. Here's the quote from the company. Following recent US government policy changes, including the termination of certain consumer tax incentives for EV purchases and the reduction in the stringency of emission regulations, we expect the adoption rate of EVs to slow.
To translate this, essentially people aren't buying as many EVs because of the removal of some of the tax credits. And as a result, GM needs to get on board and right-size some of its production. I wonder if they're the first. I wonder if they're the last.
The Republicans have basically gotten rid of these credits. You can get as high as $7,500 of a tax credit. That's the highest under the Biden administration for an EV. That all dried up September 30th. So if you're not getting that, why are you going out and buying an electric vehicle?
GM this morning, down by 2.5%. Up next on the programme, we'll catch up with Gerard Cassidy of RBC Capital Markets with bank earnings just around the corner. Plus, Herr has your morning movers. Equity futures on the S&P. The decline resumes. We're down by 1% on the S&P 500. What a ride over the previous two sessions. The biggest one-day rally on the S&P since May, following the biggest one-day drop going back to April. This morning, down again by 1.3% on the Nasdaq 100. In the bond market, super defensive morning. Two-year bond yields down by 3 basis points. 10s briefly with a 3 handle. 10s at 4 this morning. We're down by 3 basis points. That's the price action cross asset. Let's get you some single names ahead of the opening bout 3 hours away with your morning movers. Here's Yahara. Hey, Yahara.
Hi, John. It's been a swing back and forth for the semiconductor stocks as they continue to track the flare-up in U.S.-China trade relations. The latest escalation by Beijing is sending NVIDIA, AMD, and Broadcom all lower. And it's a sharp reversal for Broadcom, which just yesterday surged nearly 10% on that news that it was teaming up with OpenAI. But investors seemingly questioning whether the AI euphoria can really outweigh the latest round of trade war jitters. And it's not just chip makers feeling the impact. Rare earth stocks are extending their rally today, with critical metals up nearly 30%, while USA rare earth and MP materials are also higher, on track for a 4th straight day of gains. The U.S. sector has been surging ever since China tightened its grip on its rare earths. And we end on Stellantis, the European car maker's ADR is falling 4.8% as the credit agency Moody's changed its outlook to negative, though it did maintain its current ratings on the company. Moody's says the automaker's profits remain weak as U.S. tariffs and sluggish demand over in Europe continue to weigh on results. John?
Automaker stocks not having a good morning so far, that's for sure. Yahara, thank you. More from Yahara later on in the programme. Numbers just dropping from Wells Fargo. Here's the headline. Third quarter net interest income coming in at $11.95 billion. The estimate was $12.01 billion, so just a touch softer, lighter than expected. That stock in the pre-market, Bramo, just about unchanged.
What's fascinating here, and it kind of goes to the dichotomy that you were talking about, KKR down on the year, big banks up on the year. It seems like the actual banking and lending aspect didn't meet expectations in terms of revenues, but it came to banking, it was the opposite. Investment banking fees, $840 million versus the estimate of $742 million. You can see even provisions for loan losses coming in lighter than expected. This speaks to this question of whether Tricolor and the others are something that's endemic of some sort of credit issue or not. Provisions for credit losses, $681 million versus the estimate of $1.2 billion. So this is really coming in with sort of a read, at least on their consumers, saying there isn't as much of a credit issue, but maybe they're not making as much money from the lending portfolio as they are from just banking all of the activity that we see going on.
So that's the latest on Wells Fargo, coming a little bit earlier than anticipated, 15 minutes earlier than anticipated. The numbers from JPMorgan. With the latest, let's cross over to Scarlett Fu to break down these headlines. Hey, Scarlett.
Hi, John. Yeah, a lot of red headlines here for JPMorgan. Let's start with the capital markets and trading revenue. Equity sales and trading revenue, where JPMorgan is a leader here, $3.33 billion, handily beating the consensus estimate of $3.04 billion. When it comes to FICC sales and trading revenue, $5.61 billion. Analysts were looking somewhere in the neighborhood of $5.33 billion. Investment banking revenue, $2.69 billion, also higher than what was anticipated. Remember, this was a quarter in which there was a lot of IPO activity, there was a lot of M&A activity, and all of that shows up in these numbers here. Jamie Dimon also making some comments saying that the firm continued to benefit from higher client activity. We had gotten some kind of setup from the firm that things were looking pretty good, and the anticipation heading into these results was for a beat and raise kind of quarter, especially for the likes of JPMorgan and Goldman Sachs, which we'll be reporting a little bit later on this morning. In addition, let me just give you some more comments from Jamie Dimon. He is saying that the U.S. economy generally remained resilient. And this is critical here because we are in a data vacuum. Without any government data, investors are really looking towards these set of results to shed some light on how companies are doing and how consumers are doing. And so far, so good, at least when you look at the capital market side of the equation. Dimon continues to say there continues to be a heightened degree of uncertainty, so cautious as always. When you look at some of the bottom line numbers here, earnings per share for the quarter was $5.07. If we were comparing like with like, the consensus estimate was for $4.83. That is a big beat as well. Dimon saying some signs of softening are emerging, particularly in job growth. So again, as much as he says the U.S. economy is generally resilient, he does add a degree of caution when it comes to job growth and the uncertainty out there, especially when you think about the macro environment with all the tariffs or tariff threats flying around. Let's go back to Wells Fargo for a moment here, because those numbers came out as well, and it was a miss, especially when you look at the net interest income line, and that was the one that investors are reacting to here. Net interest income for the third quarter of $11.95 billion does miss the average analyst estimate of just above $12 billion. The bank also reaffirms its net interest income outlook for the full year of $47.7 billion, just slightly higher than what was anticipated. But the focus here really is on how Wells Fargo builds itself out after the asset cap had been removed by the Federal Reserve.
Scarlett, thank you. Scarlett, stay close to break down these numbers. We'll have Goldman in the next hour or so. If you are just joining us, welcome to the programme. So, upside surprise, third quarter equity sales and trading revenue, $3.33 billion, the estimate just north of $3. The JPMorgan third quarter fixed sales and trading revenue number comes in at $5.61 billion. The estimate was $5.33, so that's another upside surprise. The stock a little bit lighter this morning. We're down by 0.7%. Just bear in mind, year to date, that stock is higher by close to 30% for 2025. We've had quite a run. For those of you interested in the commentary from Jamie Dimon, the JPMorgan Chase chairman and CEO, here's the full quote for you. Well, there have been some signs of a softening, particularly in job growth. The US economy generally remained resilient. However, there continues to be a heightened degree of uncertainty stemming from complex geopolitical conditions, tariffs and trade uncertainty, elevated asset prices, and the risk of sticky inflation. But guess what? JPMorgan comes out with all those warnings and then prints some upside surprises.
They printed the upside surprises. I think it's important where they printed them. It goes back to the banking and trading activity. That is the upside surprise with fixed sales and trading and equity sales and trading. Interestingly, net interest income came in below expectations, akin to what we saw at Wells Fargo. I mean, look, this is light, but the expectations were very high, as you mentioned. I also think it's interesting that provisions for credit losses were $3.4 billion versus the estimate of $3.08 billion. How much is this in recognition of some of these geopolitical risks? And how much is this a signal that the likes of JPMorgan wants to take more risk because there is more upside profit on the other side? There are two ways of interpreting this, and that's what I'm going to be listening for in the commentary.
Jamie Dimon is also talking about the fact that the U.S. economy generally remained resilient amongst all this uncertainty. Meanwhile, just 6 days ago, he sat down with our own Tom McKenzie talking about there's still a chance of a recession in 2026. Meanwhile, he's saying, even though amongst this heightened uncertainty, the U.S. economy was resilient. So which is it? Are we resilient right now, or he's really worried potentially about a recession?
This is the one. It's heightened client activity. Clients have re-engaged. Corporate clients have re-engaged. You've seen that in the deal flow. You've seen that in the debt issuance. You saw that through the whole of the month of September. The biggest leverage buyout on record. Debt issuance. Tons of supply. Clients have re-engaged in a major way going towards year end.
What we heard from Jefferies kicking off the earnings season for the banks was an unprecedented amount of revenue from activity, from deals, et cetera. You see the same type of activity in Wells Fargo. You see the same type of activity in JPMorgan. How big is that pipeline, and how bulletproof is it to any potential shock coming forward? Is it predicated on the idea of rate cuts, or is it the companies see an opportunity in a wide open capital markets that these banks are happy to facilitate?
Gerard Cassidy of RBC Capital Markets standing by. Gerard will be with us throughout this morning breaking down these bank numbers. Gerard, welcome to the programme. First of all, JPMorgan, upside surprise on equity sales and trading revenue, likewise for FIX. Gerard, is that a sign of things to come later this morning?
Jonathan, I think it is. And we all know that the markets have been very resilient in the third quarter, as these numbers point out for both Wells Fargo and JPMorgan. The trading numbers were better than expected, as you pointed out. And it really, I think, portends well for the others that are in that business, of course, Goldman Sachs, Morgan Stanley, as well as Citigroup and Bank America.
Gerard, Jamie Dimon highlighting all the risks out there. I see them too. We all do. Geopolitics, tariffs, trades. But ultimately, Gerard, there's something about client activity and clients re-engaging into year end. What do you think is behind that, Gerard? And what do you think makes it sustainable into 26?
Yeah, and I think what we're seeing is that a lot of pent-up demand was pushed from 2022 and 2023 as well as 2024 into this year. And so you might recall that the activity a couple of years ago was quite depressed in the mergers and acquisition area as well as IPOs. And so I think what you're seeing now, because of the resiliency in the markets, because of a more supportive approach out of Washington with this administration on mergers, you're seeing a lot of activity that could have been done over a year ago, and now it's coming through right now.
What's your takeaway, Gerard, from the fact that, as John was pointing out earlier, KKR and the other big private asset managers have seen their shares fall quite a bit this year? There are concerns about credit issues within some of their portfolios. And now banks, which previously had decried the competition from some of these private asset managers, are delivering huge returns from the activity aspect of their business. Does it suddenly look like a pretty good business model and maybe prevent them from getting into the lending business as much as maybe they had hoped a couple of years ago?
It's interesting, Lisa, because you might recall back in July of 2023, the Federal Reserve put forward what they called the Basel III endgame, and it was going to raise the capital levels for many of our biggest banks substantially. So as a result, these banks went on what they called at the time risk-weighted asset diets. They pulled back from lending. And so the alternative asset managers, the private credit markets, had a field day. In fact, Jamie Dimon commented about how uncompetitive this Basel III endgame was. And now, as we know, that's been thrown out. A new Basel III endgame is coming, possibly by the end of this year or into next year. And it's going to be much less constrictive for the banks. So the banks are back in the game. So I think part of the reason maybe the alt asset managers like a KKR are not doing as well this year is that they do have now real competitors in the banks. And then second, the growth has been spectacular for these companies. And whenever you have rapid asset growth, you always have to be a little concerned that could there be some issues on credit down the road. And also the numbers are very opaque. So that I think is a combination of why those companies might be struggling versus the banks now really excelling.
Gerard, stay close. Just want to jump in with the outlook from JPMorgan. Now seeing full year net interest income of about 95.8 billion. The previous outlook had about 95.5. We've seen this movie so many times, haven't we, Lisa? JPMorgan comes out with a beat. Jamie Dimon comes out with a lot of cautious commentary. And then a headline drops about 2 minutes later, raising the outlook.
Look, this is clearly someone who views himself as a risk manager at a time where the risks seem to be always to the upside. It's also the key sandbagging that JPMorgan is known for. I wonder, Gerard, how you can put these two things together, or whether the sort of pipeline of deals, the pipeline of activity that's fueling a lot of these earnings can really sustain themselves, given some of the risks that Jamie Dimon keeps highlighting, but haven't really come to fruition in terms of market performance.
You make a good point, Lisa, and the classic wall of worry that we see out there, and markets tend to do pretty well as we climb that wall. But Jamie Dimon is a conservative CEO, as he should be, and he's always going to point out the big risks that are out there, while at the same time, they run their business day by day. They execute day by day. And right now, we're in a very strong investment banking market that's akin to what we saw in 2021. And so I think what you're going to see going forward, as long as the market conditions remain resilient, companies will come public. There will be more mergers going forward. And the investment banks obviously are the beneficiaries of that kind of activity.
Gerard Cassidy of RBC. Gerard, you're going to stick with us. Looking forward to catching up some more, anticipating those numbers from Goldman Sachs. A lot of the story we're talking about around the banks is pretty well understood. It's reflected in the share price rally we've seen so far year to date. Slight move lower off the back of those numbers on JPMorgan. Now that stock turning positive, up by about 1/3%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief with the latest worldwide. Here's Lizzie Burden. Hey, Lizzie.
Hey, John, a reminder of those earnings. JPMorgan reporting third quarter revenue that beat the average analyst estimate. The bank also recorded beats on equity sales and trading revenue. And the bank's chief executive, Jamie Dimon, is saying that the economy remains resilient. However, there continues to be a heightened degree of uncertainty. Elsewhere, Wells Fargo also reporting earnings this morning. The bank raising a key profitability metric, marking the first major update about the bank's next growth target after the removal of regulatory restraints. However, Wells Fargo did report a miss on net interest income. The company also reaffirming that its guidance for net interest income remains steady and stands. And shares of General Motors sliding after the automaker announced a massive $1.6 billion charge related to shifting electric vehicle production plans. GM cited the end of federal EV tax credits and relaxed emission standards for the expected hit, writing in a regulatory filing, "We expect the adoption rate of EVs to slow." And that should be my brief. John.
Lizzie, thank you. Appreciate it. Thank you very much. Up next on the programme, we'll break down the latest. So far, so good for the big banks on Wall Street. Lizzie went through the numbers. JPMorgan up by 1.3% of the pre-market. Wells up by 2.6. Goldman Sachs 45 minutes away. Gerard Cassidy of RBC still with us. So we've had numbers from JPMorgan, from Wells Fargo already this hour. The numbers were okay, and it fails to put a floor under this equity market. Equity futures down, taking another leg lower. We're down by 1.3% on the S&P, on the Nasdaq down by 1.6%. In the bond market, check it out. Fixed income, 2-year, 10-year, 30-year bond yields. Bonds hold on to those gains. Yields are down by 3 basis points, just about holding on to 4% on 10s, 2s. At 347.
If we revisit an April 2nd type of decoupling between the U.S. and China, banking activity that might be in the pipeline won't be enough to really get people back on the sides of trying to boost valuations further. I just wonder where the off-ramp is and whether this market is trying to suss out that maybe this time it's going to go on a little longer, or maybe this is a good selling opportunity, lock in the gains and wait for a better entry point.
Let's talk about the latest. Wells Fargo, JPMorgan reporting just moments ago with the latest. Here's Bloomberg's Scarlett Fu. Hey, Scarlett.
Hey, Jonathan. So we're looking at JPMorgan erasing earlier declines. It's now up slightly here. Coming into these results, the idea was that there would be potential upside to the capital markets revenue. Check. That's exactly what we got, with a beat on both FIC trading, fixed income currencies, commodities, as well as equities trading. And this was the case where JPMorgan had already guided higher in September for both of those businesses. We also saw a solid net interest income for the quarter, and in fact, JPMorgan boosting its full year net interest income to $95.8 billion from the consensus estimate of about $95.47 billion. We're also hearing some cautious commentary from Jamie Dimon, the CEO, saying that the U.S. economy has remained generally resilient, but he does see a heightened degree of uncertainty, particularly when it comes to job growth. Assets under management for this company also swelling to $4.6 trillion thanks to the booming stock market, which increases the value of those assets. Provisions for credit losses does increase as well, so kind of in tandem with that cautious commentary from Dimon. $3.4 billion set aside for potential bad loans. Analysts were looking for somewhere in the neighborhood of $3.08 billion. Let's move on to Wells Fargo, which is a stock that has kept pace with the S&P 500 and its peers so far this year, but since the last earnings report has really underperformed. So you could see it's gaining about 1.3% so far today in the early trade. Net interest income for the quarter that passed did miss analyst estimates, but the bank maintained its full year forecast of $47.7 billion in net interest income. And more importantly here, it aims to achieve tangible common equity return of 17 to 18% in the medium term. That is an upgrade from its previous guide of about 15%. And just as a point of comparison, JPMorgan's target for the medium term of tangible common equity return is about 17%. Wells Fargo, of course, has been constrained by the asset cap imposed by the Fed. It was the case for about 7 years, and the Fed just lifted that not so long ago. So we're looking at other parts of the business that it's growing. Investment banking fees increased 25% to $840 million. Analysts were looking for 741.6. I know that's a drop in the bucket compared to the likes of JPMorgan, but it's an area that Wells Fargo is certainly looking to grow.
Scarlett, thank you. Scarlett Fu with the latest. More from Scarlett later this morning. Numbers from Goldman Sachs, 40 minutes away. Gerard Cassidy of RBC still with us. Gerard, let's pick up on what Scarlett was talking about. This story's pretty well understood. That's reflected in the rally we've seen already in the names so far this year. The challenge for people still in the stock. Story's well understood. How full is the valuation?
In terms of JPMorgan, John, the valuation is full. But if they continue to deliver 20% return on tangible common equity and numbers like you saw today, you can see obviously the tangible book value per share continue to grow. And even if the valuation remains unchanged, there's still upside in the stock.
What do you need to hear, Gerard, on the call in terms of either AI adoption or future points of revenue going forward to say it's still a buy, even with full valuations?
It's a very fair question. And I would say that one of the areas I think investors are going to focus on is the traditional banking area. JPMorgan reported very nice loan growth on a year-over-year basis. And yes, we all know about the capital markets business, investment banking being very strong, but it's really going to come down to also the traditional banking businesses and what kind of growth they're going to see. And again, they saw very good growth today in the year-over-year loan growth. So that will be one of the areas I think people will focus on. And then the sustainability, of course, of those capital market numbers.
Going forward, I wonder how the announcement that we got from JPMorgan yesterday kind of plays into the future earnings revenue. We heard that they're planning to increase their investments to strategically important companies in the United States, potentially investing alongside companies that the U.S. is taking a stake in or the ones that might be relevant to that type of effort. Does that move the needle at all, or is that a drop in the bucket when you start talking about $95.8 billion of net interest income in a year?
It certainly doesn't move the needle, but it's very important. JPMorgan is our largest bank in the United States. And Jamie Dimon has always expressed his desire to be a very strong supporter of the U.S. economy and the U.S. in general. So in our view, when you come out with an announcement like they did yesterday, he's putting his money where his mouth is, if you will, and he's investing in the United States. He believes in our country. He believes in the democracy, and he's a leader. And he's showing it with this type of announcement, in our view.
If he's putting his money where his mouth is, given yesterday's announcement, given today, he's talking about complex geopolitical conditions. Do you think this means the bank might take steps to de-risk from China, they themselves?
I would certainly say that they're always on their guard when they talk about their global expansion. And when you're expanding into a communist country like China, you've got to be especially careful. And so I don't necessarily believe they're going to pull back from that. But certainly there has been, under this White House, an increased focus on investing more into the United States. And it's also due to the fact that if you think back during the pandemic, the supply chain disruption was dramatic. And many of the investments we're seeing today is as a result of that. And I think what you're seeing here, JPMorgan is also now taking a very sharp look at looking at the critical industries that they want to support with this announcement they made yesterday.
Gerard, it's good to see you. You're going to stay with us, I know. You're going to break down the numbers with Goldman Sachs in about 35 minutes' time. Stay close. Gerard Cassidy of RBC with the latest on Wells Fargo, on JPMorgan. I think we've got to bring you the latest on the broader equity market because this downdraft continues. Took another leg lower in the last 15 minutes, even with fairly decent bank numbers from the likes of JPMorgan and Wells Fargo. Equity futures down by more than 1% on the S&P 500. And we're holding on to those losses, even with an upside surprise on some of the banks so far.
It all comes down to this question of whether the U.S. and China can repair what seems to be an escalating feud, and really whether they can even meet with Xi Jinping and President Trump on November 1st, given the rhetoric that we've seen, which seems to be only heightening. And China's response wasn't necessarily the same type of conciliatory language that we got from Trump. And for that reason, people are saying, hold on a second, things are already looking pretty frothy. Why don't we just take some chips off the table despite what we see from the banks?
The Financial Times reporting also giving some context and depth of what China has been coming out with. They said that this was on the list of negotiating bargaining chips China presented in the summer. And the lead negotiator said to them that they will be very aggressive and then the U.S. would face, quote, hellfire if things didn't go their way. They were using this in the summer and then came out with this right ahead of potential sit down between Xi Jinping and President Trump. It took 18 months to just get agricultural purchase agreement done. Trump won. Does anyone think this is going to get done in 2 weeks? The
big difference between the risk aversion of the last few days and the drama of April, this rally in the bond market, 10-year bond yields close to 4%, twos at 347. Coming up next, Shalett of Morgan Stanley, the Republican Congressman Mike Lawler, Herr of JPMorgan, and we get more bank earnings with Gerard Cassidy of RBC.
The economy in the US is very strong.
There are some signs of slowdown within the labour market, but we're not talking about recessionary.
We have a slowing in terms of the economy, but we don't have an outright contraction.
Most of the data is telling us that we're seeing slowing economic growth, but no recession.
Macro is weakening enough. We are a bit more confident that the Fed can deliver.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. And your scores look like this. Declines across the board. We're down by 1% on the S&P 500, down by 1.5% on the Nasdaq 100. Okay numbers from Wells Fargo and JPMorgan failing to lift the mood this morning. Wells Fargo higher by 1.6%.
So they came out with banking activity in particular really beating expectations, whether it's trading, whether it's the M&A that we have been seeing. As you point out, though, right now what is taking the dominant stage is this tit for tat between China and the U.S., and it shows how much a re-escalation in trade wars can overwhelm really good bank earnings. So it raises the question, even if we do get corporate America firing on all cylinders, are we susceptible to something on a geopolitical level that torpedoes the dynamism that we've seen in equity markets?
You see that tension, that risk aversion bubbling away in fixed income so far this morning. In the bond market, 10-year bond yields down by 3 basis points, just about holding on to 4.
When it comes to this rhetoric between Washington and Beijing, I don't think it's going to stop today. It is going to continue until these two leaders meet, and potentially there's not going to be an outcome come 2025. This might bleed into 2026. Maybe they put a lid on it, but it doesn't mean we're going to get some grand bargain deal because there's no deal on the table right now. And usually you would see the Chinese president only agree to a summit when a deal is in place. The more important meeting, I think, is when the Treasury Secretary sits down with his counterpart and potentially we get leaks of a contour of what could be agreed upon when it comes to this relationship. Right now, it's about ships. Last week, it's about rare earths. Who knows what it's going to be at next week?
That seems to be the factor right now in equity markets worldwide. Later this morning, we get more bank earnings. Goldman Sachs is about 29 minutes away. After that, we'll hear from Citi. Later on this afternoon, Chairman Powell, 12:20 Eastern Time. It's amazing how little people talk about the Federal Reserve over the last few weeks with regards to this market. I'm stunned by it. We have guests come on to talk about 10, 15 minutes about the market and barely touch on the Federal Reserve.
Because what are we going to say about the Fed? They are data dependent and we have no data. They are completely split and we don't know who the Fed chair is going to be next year. Ultimately, they are following the market. They are not necessarily leading the market. And I think that that is the truth. Right now, people are expecting them to cut 2 times this year. And they're saying that there is enough consensus on the committee that probably can get behind that. Okay, we can forget about that because any forward look beyond that is completely irrelevant because it is a completely different Fed come spring of next year.
Let's see what Chairman Powell delivers later on this afternoon. Enjoyed the rant.
Thanks.
Right there with you.
What are we going to say? What
I
are
was
we going
like
to parse
clapping
through?
along. Lisa Shalett was there too. Sort of nodding away.
Plus, it's the easiest job in Washington, Jonathan. It's a coin flip. You know that.
Donald Trump's absolutely right. The president nailed it.
All right.
Okay. Coming up, Lisa Shalett of Morgan Stanley as bank earnings deliver some upside surprises. Gerard Cassidy of RBC with Goldman numbers coming up next. And Herr of JPMorgan ahead of Fed Chair Jay Powell's latest address. We begin this hour with big banks failing to lift equity markets. Stocks down across the board, the S&P negative by more than 1%. Joining us around the table, Lisa Shalett of Morgan Stanley Wealth Management. Lisa, good morning.
Good morning.
Do you agree with Bramo on the Fed?
Absolutely, actually. Not unusual that I agree with Lisa, but fundamentally, it's not entirely clear what would catalyze the Fed to change its view, what would catalyze a shift in the Fed funds curve.
How relevant is Fed policy to this rally and valuations at the moment?
I think it's been very, very critical. But to Lisa's point, I think we've baked in what we can bake in at the moment, knowing what we know. And it's been pretty concretized. I mean, one of the things we've observed is the extent to which underneath this rally over the last 10 weeks, you've had this really kind of pro-cyclical, junky broadening. Right, where you've really seen small caps lead, you've really seen micro caps lead, and that kind of thing is very much premised on much lower interest rates. And we're in the camp that says that piece of this trade may have gone too far.
Is there something that we're interpreting maybe a little bit incorrectly with the broadening out in the rally in asset prices? And John was mentioning earlier this rally in gold and stocks, this idea that you see haven assets rallying at the same time that you see risk assets rallying. Is this a sign of inflation percolating through where it can, and this question of dollar debasement on the heels of the Fed set to cut rates regardless of what the inflationary backdrop really is?
Very much so. I mean, this is a case when the everything rally, right? When bonds are going up, stocks are going up, gold is going up. It tells you that there's still too much liquidity, sloshing around in the system. And here's the Fed signaling, that they're prepared to give us another 100 bips. In an economy that right now looks like U.S. GDP is, growing at a real basis at least 3%. I mean, this crazy town.
Well, does it give you confidence that we are seeing a rally in treasuries amid the crazy town in the face of some potential exogenous shock in the form of some sort of geopolitical decoupling? I mean, the idea that we're seeing that rally, as John was pointing out, in the long end of the yield curve, maybe giving a bit of a softening to that, saying, well, actually, maybe this is a normalcy in terms of the reaction function of government bonds.
I'm not sure that what we're seeing is all that normal. Like I said, the degree to which cross-asset correlations, I should say, are so close to one, just makes you think that there's a huge amount of liquidity out there and people are buying everything hand over fist.
What do you make of the recent tension between Washington and Beijing, the decoupling Lisa's talking about? Are we going back to that volatility we saw in April?
I don't know that we're going all the way back to April, but I think we're getting to a much more realistic place. We went from in April, the world's coming to an end, to, after April 9th, only kidding, nothing's going to happen. This is all going to go away and be nothing. I think the reality is that unlike some of the other economies where, the United States has kind of essentially dictated a deal, it is very clear that our relationship with China is very different. And there's much more equal balance here. We need things from them. And they need things from us. And that means you're actually going to have to negotiate, not something that this administration has demonstrated a very, robust track record. They've done a very good time at dictating thus far. And so I think that this could be a little bit drawn out because there are going to be puts and takes and some compromises.
If this gets drawn out and there's no agreement when these two leaders meet, what kind of market reaction could we see?
I think this is where some of the tempering in the market, comes in. Our best guess is it's not necessarily a material correction, but it's a consolidation in the market. And I think you get back actually to the big getting bigger and a concentration in the high quality names and some of that lower quality trade that I talked about, kind of coming off. Some of the sizzle, some of the froth coming out of this market. As folks realize, okay, wait a minute, this is some serious stuff. Who really wins here? And my guess is it's going to be the bigger guys are going to be able to survive this.
Lisa, let's talk about some other serious things in private markets. I think people find it difficult to take the temperature of what's happening over there. And they use some public market proxies, like the stock of a KKR or an Apollo, which is down around 20% so far year to date. And they point to certain idiosyncratic issues, if we can call them that, the likes of First Brands and Tricolor. And they're trying to work out just what is going on here and what does it mean for me in public markets over there. How do you answer that question at the moment?
So that's a fantastic question because I think it speaks to this disconnect between the small mid-cap world, which is really what is inside of these private equity portfolios. And our thesis has been, if everything is perfect in private equity world and portfolio world, why aren't we seeing more deal activity? Why aren't we seeing more distributions? And our thesis has been because there's a little bit more pain there, because there are high borrowing costs there, there is some stress there. Those portfolio companies are feeling some of the brunt of tariffs and pressure on margins and the borrowing costs. And so, from where we sit, what you're seeing in the public equities of some of these general partners is reflective of that stress. And it is telling us, I think, and confirmatory of our view that some of the smaller micro-cap, mid-cap stocks that have run, maybe are overheated.
What's the difference between weakness and a sense that there is more pain in some of these areas versus systemic risk, which is what some people are worried about, a credit event that could potentially precipitate something more pernicious.
Yeah, so there's always the risk that, you have credit events in these kind of markets where people have taken on leverage. I think one of the things that folks hope is that because some of the froth in the lending has occurred in the private markets, that it's not systemic. And for the moment, we're willing to buy into that argument.
Lisa, it's good to see you.
Good to see you
Thanks
guys.
for breaking it down. Lisa Shalett of Morgan Stanley. Some concerns about what's happening in private markets here, reflective of maybe what's going on in the broader economy, more so than what's happening at the top of the S&P 500.
What I find interesting is you're not seeing that kind of stress necessarily at the big banks or in their balance sheets, and how much are they catering to a very different clientele now that is better financed, wealthier, bigger companies, and they can be insulated from the stress that you see much more consolidated in some of these private asset companies, not because they're taking excess leverage, but because of the aspect of the market that they're catering to.
It's well said, very well said. The latest numbers from Wells and JPMorgan, pretty decent. Goldman Sachs, about 20 minutes away. Let's get you an update on that and a whole lot more with your Bloomberg brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. JPMorgan reporting third quarter revenue that beat the average analyst estimate. The bank also recorded beats on equity sales and on trading revenue. The bank's chief executive, Jamie Dimon, saying that the economy remains resilient. However, there continues to be a heightened degree of uncertainty. Elsewhere, Wells Fargo also reporting earnings this morning. The bank raising a key profitability metric, marking the first major update about the bank's next growth target after the removal of regulatory restraints. However, Wells Fargo did report a miss on net interest income, and the company also reaffirming its guidance for net interest income remaining steady. And Ukrainian leader Volodymyr Zelensky is planning to meet with President Trump in Washington on Friday. The two will discuss air defense and weaponry as Russian strikes on Ukraine's energy system intensify. Zelensky is looking to secure long-range Tomahawk missiles from the US, and he also plans to discuss importing natural gas from the EU, Norway and others. And that's your Bloomberg brief. John?
Hey, Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, the promise of pay.
We are so very grateful that President Trump has stepped up to ensure that our troops are going to be paid on October 15th.
Until Donald Trump gives them permission to meet, they're going to continue to hide as it relates to sitting down and negotiating a bipartisan agreement.
I think it's fair to say the president's been pretty busy elsewhere over the last 24 hours.
Oh, you don't say.
Shutdown doesn't exist for him.
I mean, come on. I mean, for good reason, too.
Yeah, well, I think that there's been a very big geopolitical tint at the same time of a government shutdown in the United States.
Up next, we'll get into the main debate down in Washington, D.C. We'll catch up with the New York Congressman, Mike Lawler. He joins us next. Live from New York City this morning. Good morning. We're recovering somewhat, still down by 1% on the S&P 500. On the Nasdaq, we're down about 1.3. Talked about these moves in fixed income in the bond market with this tension rising, rebuilding between the US and China. Two-year bond yields down 3 basis points, 10s down to 4% on 10 so far this morning. Said this a few times in the last 60 minutes. The bank earnings have been okay. Wells Fargo, JPMorgan, Goldman coming up later. It's just failed to lift the broader equity market, even with gains for JP and for Wells.
You have this broader concern about geopolitical tensions. You also have, of course, the idea that these big banks aren't necessarily banking the entire consumer base of the United States, and that there are different consumers, some of whom are struggling more than others. But I think that the bigger point here is valuations are elevated, and there still is quite a bit of uncertainty. And that reality is coming to the fore this morning.
That's the latest on the stock market. Remember, you will hear from Chairman Powell later on this afternoon, 12:20 Eastern Time. Under surveillance this morning, the military getting paid.
The Democrat Party is utterly rudderless. We are so very grateful that President Trump has stepped up to ensure that our troops are going to be paid on October 15th, while we wait for Democrats to stop holding the country hostage.
Speaker Mike Johnson and I have not met. We know that until Donald Trump gives them permission to meet, they're going to continue to hide as it relates to sitting down and negotiating a bipartisan agreement.
So here's the latest this morning. Americans feeling the pinch of the shutdown stalemate. President Trump promising to pay troops tomorrow, but holding back checks from other federal workers. With the latest down in D.C., in Washington, here's Bloomberg's Tyler Kendall. Morning, Tyler.
Hey, John, good morning. So some of the pressure points are being eased, but there is little sign of progress as the Senate returns to Washington today, but the House still remains out of session. Now, the White House has confirmed that both the military as well as members of the U.S. Coast Guard are going to get their paychecks this week. The military is going to see their pay funded by $8 billion in unallocated funds for research grants within the Pentagon, while the U.S. Coast Guard is going to see some funds redirected within the Department of Homeland Security. The White House is also maintaining that a key supplemental nutrition program for women and children will be funded through tariff revenue. And while both sides of the aisle are at least quietly happy that the administration is making these moves, ultimately all of these moves are facing legal scrutiny since Congress didn't appropriate the funds for this reason. Plus, there are a lot of other issues that don't have as immediate of solutions. Everything from small businesses seeing federal loans halted to companies reporting issues issuing stock and other securities since most of the SEC is currently furloughed, not to mention that there are delays nationwide at airports with a shortage of air traffic controllers. Now, Republicans maintain they're not going to negotiate with Democrats until the government reopens, but our understanding is there are at least some bipartisan informal conversations happening on Capitol Hill about some structural changes to the Affordable Care Act premium tax subsidies in exchange for an extension. But, John, at this point, it doesn't appear that it's happening at the leadership level. Now, November 1st is the beginning of open enrollment. That could be our next big pressure point, but that's still 2 weeks away.
It's Tyler Kendall with the latest down in Washington. I'm happy to say we can extend the conversation with New York Congressman Mike Lawler. Congressman, welcome back to the program, sir. The good news, the military looks like it's getting paid. Can you just walk us through how you would characterize current negotiations?
The Democrats refuse to do their job. You know, Hakeem Jeffries talks about getting permission. The reality here is that AOC and Zohran Mamdani and the progressive left are who's driving the ship here. Chuck Schumer and Hakeem Jeffries have been petrified to do their jobs, and so they shut the government down for fear of a primary challenge from the left and to show their progressive base that they're, quote unquote, fighting back, resisting, President Trump. And it's fundamentally wrong. They are holding the American people hostage. House Republicans passed a clean continuing resolution over 3 weeks ago to keep the government funded, to pay for all of these critical programs, to ensure that our troops are paid, to ensure that Border Patrol agents are paid. And yet Democrats have voted over 8 times against the clean CR. And we'll see what Chuck Schumer and Senate Democrats do today, but it doesn't look good. When I was in Washington last week, I went and confronted Hakeem Jeffries to his face and pointed out that if he's serious about tackling the health care challenges in our country, sign on to the bipartisan legislation that would do that. And he refused. So this really is not about health care. It's not about a specific policy outcome. This is about Democrats showing their progressive base that they're fighting back against President Trump. Meanwhile, look at the juxtaposition. President Trump, on a 24-hour trip to the Middle East, secured peace, and Democrats are playing patty cake here in Washington, D.C., shutting the government down and holding the American people hostage.
Well, we're 2 weeks in. There needs to be some off-ramp at some point. Would you support structural changes to the Affordable Care Act, premium subsidies, in exchange for an extension to get the government back up and working?
Well, to be clear, the off-ramp is the clean CR that's been sitting in the Senate for over 3 weeks. With respect to the Affordable Care Act, number one, since Obamacare took effect in 2010, you've seen premiums skyrocket across the country. And Democrats put in place these enhanced tax credits during COVID. They were slated to expire at the end of this year. Democrats knew that. They passed it into law. And they knew that they couldn't extend it beyond that period because of the cost associated with it. I have signed on to legislation to extend it by a year because we don't want Americans' health care premiums to spike. But it speaks to the fundamental problem with Obamacare, which is that it didn't actually do what it was intended to do, which is reduce health care costs in America. And in fact, it has exploded since its inception. So Look, I am open to obviously solving the issue, both short term and long term. We have to address the cost of health care in this country. But Democrats just, pounding their fists on the table, stomping their feet and demanding their way is not the way to govern. You don't hold the American people hostage. And by the way, don't take my word for it. Go look at every quote from Chuck Schumer, Hakeem Jeffries, Nancy Pelosi, and name the Democrat. They all previously believed that you don't use government shutdowns to exert policy outcomes. And now fundamentally they have changed their view because Donald Trump is president.
Congressman, also being held hostage right now is data, which the financial services industry, the Fed, we all rely on. You are on the Financial Services Committee. Do you think the White House should deem the BLS data, like the jobs report we're still waiting on, essential?
Look, obviously that information is critically important for the Fed and others to do the work that is required. But this is the fundamental challenge. They're trying to figure out how to pay for instance, our troops, which is vital. They're trying to figure out how to pay for critical programs like WIC and SNAP. And so these are the very difficult decisions that any administration is put in because of the incalcitrance of my Democratic colleagues here. Look, I've been opposed to government shutdowns regardless of who has tried to do it. I criticized my Republican colleagues last Congress when some of them wanted to shut the government down over Joe Biden's disastrous open borders. While I agreed with them on the merits, the fact is shutting the government down wasn't going to solve that problem. And the same applies here. What the Democrats are doing is creating more problems. The Fed, to your point, needs to be able to do its job. They need to cut rates. They need the information with respect to jobs, for instance. That is critically important. So, yes, we want them to be able to get that information. The fastest way for all of this to come to an end, the fastest way to ensure that government does its job is for my Democratic colleagues to go back to Washington today in the Senate and vote yes to open the government up and pass the clean CR.
The White House has also taken aim on projects in New York City, $18 billion worth of New York City infrastructure projects. You are in a swing district and you are facing a lot of challenges. A lot of Democrats are lining up to try to flip that seat come the midterms. Are you concerned about potentially the pushback you're going to get from things like this, billions of dollars being frozen right here in New York?
Look, I've already spoken out against the freeze on that project, and I've been in touch with the administration to get that project back up and running.
Are they going to?
But again, the fastest way to do that is to pass a clean CR. And that's the point that I've made over the last week to my New York colleagues and to the press, that these projects can easily come back online when the government is open and running. Gateway is a critical project for my district. We don't have a one-seat ride from Rockland County, where I live. Gateway will provide that. So this is a critical infrastructure project, not just for New York City or New Jersey, but for the region. But this is something that I've fully supported in terms of getting the funding for that project, and will continue to fight to do it. But again, based on conversations, it's not that hard to figure out. If you open up the government, a lot of this stuff will be resolved.
Congressman, we got to go. Appreciate your time as always. I'm sure you've got to go too. Mike Lawler there, the New York congressman, on the latest situation down in Washington, D.C. The latest situation on Wall Street, a big beat for Goldman Sachs. Third quarter fixed sales and trading revenue, $3.47 billion. The estimate, $3.18 billion. We'll get into those numbers in just a moment. Gerard Cassidy of RBC is with us next. Live from New York City, welcome to the program. What a volatile few sessions since Friday. Friday, the biggest one-day loss since April on the S&P 500. Monday, the biggest one-day gain since May. This morning, we're down again by 0.9% on the S&P. On the Nasdaq 100, we're down by 1.23. Lots of earnings to talk about. JPMorgan and Wells Fargo already reporting just moments ago. Goldman Sachs, we'll have more on that in just a moment. With your movers this morning, here's Yahira. Hey, Yahira.
Hi, John. We start on the banks, and with JPMorgan up first, shares are slightly lower, down about 0.1%, even though it crushed it in trading and investment banking. No surprise there with all the volatility we've seen in markets, plus the level of IPO activity and data center financing. Meanwhile, turning to Wells Fargo, those shares are up 2.3%. While it's not a big player in the space, it also posted better than expected investment banking fees. Wells did slightly miss on net interest income, though those shares are brushing it off, up 2.3%. Another company reporting results this morning is Johnson & Johnson with a beat and a raise. Those shares are down about 0.2%. The market really punishing stocks this morning. Investors were also cheering its plans to separate its slower growth orthopedics business within 18 to 24 months. And we end on GM. Shares are falling 1.7% now after it said it will incur a $1.6 billion charge in the third quarter as it reassesses its EV plans due to slower demand. It cites the Trump administration's moves to end the federal EV tax credits and relaxing emissions rules. Remember, GM had been pushing hard into EVs, but now it says that it expects the adoption rate to slow. John?
Yahira, thank you. Thanks for the update. More from Yahira in the next hour. Let's get some more on the bank earnings. Record third quarter revenue for Goldman Sachs. With the details, here's Scarlett Fu. Hey, Scarlett.
Hi, John. Yeah, Goldman Sachs really delivering on its traditional areas of strength, trading and investment banking. Investment banking revenue rose 43% year over year. Advisory revenue rose 60% year over year. And underwriting rose 21% for equities and up 30% for debt. Now, when you look at trading overall, there's a bit of a wrinkle when you break it down into asset classes. For FIC, fixed income, currencies and commodities, that rose 17% to $3.47 billion, handily beating the average analyst estimate. But the equities trading rose 7%, and that missed the consensus estimate by about $200 million, $3.74 billion reported for the quarter. Goldman also set aside less money for bad loans for the quarter, setting aside $339 million versus the consensus estimate of almost $370 million. In addition, for these big banks, their biggest expense is compensation. And operating expenses did increase 14% year over year, more than anticipated. Compensation expenses rose by the same amount, 14%, more than anticipated as well. One thing to keep in mind with Goldman, of course, is that it is the most exposed big bank to investment banking revenue. So it'll have the fastest response among all these different firms that we track to recession risks or any kind of erosion or deterioration in market conditions. But for now, this looks like a solid number, especially on the investment banking side.
Scarlett, thank you. More from Scarlett later on this morning. Just go through this line by line. Advisory revenue beat, global banking and markets beat, investment banking beat, record third quarter revenue for Goldman Sachs.
And it comes from a lot of pretty steady revenues. It's not just the idea of markets going up or down. It's the financing activity, the prime brokerage activity, record quarter in both the FIC side of things as well as the equity in terms of that type of financing activity. I just wonder whether this really is going to be a tell about the vulnerability that Scarlett was saying going forward to the deal making kind of coming off, or what they see in terms of the pipeline. Is there going to be an ongoing activity pipeline that is similar to what we just saw in the third quarter?
Gerard Cassidy of RBC Capital Markets still with us. Gerard, you touched on this earlier on this morning. Let's build on it. Lisa was just talking about it. You talked about the pent-up demand. How much of it is just pent-up demand? How much of it is new business that can carry through, push through into next year and beyond?
Jonathan, it's a really good question, and we're going to get those answers, I think, on the earnings calls for Goldman Sachs and JPMorgan, because we have to remember private equity, when you look at their portfolio companies, we hear from those firms that they need to monetize those investments. And because of the slowness in the IPO market in 2024, we're likely to see more of that take place in 25 and 26. And to your point, Jonathan, about the advisory business, a way to monetize those investments, of course, for those private equity companies is to sell some of those portfolio companies. And I think you're going to see more of that. So I think we're going to hear good news on the future pipelines from these companies about advisory revenues as well as ECM activity.
How much, Gerard, is that a broader read on the economy versus a specific sector that has a lot of pent-up demand? And it's important because if you do believe that there is this potential for geopolitical risk or if rates aren't cut as much, is this a vulnerable type of pipeline that could be building?
The pipelines for the investment banks are always market dependent. And I know that's an overused term, but it's true. And so you're right. If there's elevated global risk, that certainly makes those pipelines a little more fragile. But right now, the U.S. economy, as you guys know, when you take a look at the Atlanta Fed forecast for what they think it's growing at is well over 3%. So that's real positive for this type of investment banking market. So the outlook is more, I would say, of robust growth here in the U.S., even though you do have those global tensions, which does add to the risk.
Goldman Sachs emphasized a lot of their repeat revenues, whether it's the financing business, the prime brokerage efforts on the part of FICC and equity investment units. There's also a question about asset and wealth management and some of the record management and other fees that they brought in. How much do you view this as a bank that is more insulated to a cycle versus something that is more susceptible to the ebbs and the flows in market activity and just market sentiment?
So they're always going to be a prisoner, if you will, of the markets. And that's not necessarily a negative term. But yes, they have diversified into more predictable revenues, as you described, the wealth management area being one of them. And I think what you're also finding is that under the leadership of David Solomon, they have really decided to increase their penetration in their top 150 institutional accounts. And they've had real success there. They want to be number 1, 2, or 3 with those accounts for that repeat business that you just described. So, yes, they are improving that. They are having more predictable revenues. But we also have to remember the biggest part of their business still remains trading and investment banking. And there's nothing wrong with that. But it is something that you have to be cognizant of in terms of market conditions.
We're talking about also any kind of read through to the underlying consumer. And we point to the idea that credit losses, Scarlett was mentioning, came in lighter than expected at $339 billion versus the estimate of $369.6 million. All of these are rounding errors when you look at their actual revenues. Is there any tell from that in terms of the broader economy and any potential slowdown in certain sectors? Or is this completely different because they're dealing with high net worth individuals who have a very different credit profile than maybe some of the areas that are seeing bigger pockets of pain in the United States?
It's interesting because it's ironic when you look at their credit, the consumer credit side of Goldman Sachs, it's really not high net worth. It's, I would argue, when you look at the FICO scores, it would be, middle market down to above, near subprime, but not subprime. But we also saw that JPMorgan in their outlook piece, they lowered their credit card loss expectations. So what we're seeing on the consumer side is, yes, that subprime, the low FICO score consumer is certainly struggling with the higher inflation, lower wage gains, but the middle market and then the emerging affluent and affluent markets are still very healthy. And that's where most of the banks focus their lending on. They're not going after the subprime market. And earlier, when we were talking about credit, we have to also remember post-financial crisis, the U.S. banking industry has been de-risked. And that's also showing up in these numbers today for all the banks.
Gerard, is the same true for the regional players, the regional banks?
John, absolutely. Now, of course, we have the idiosyncratic credits that you guys have talked about with First Brands and Tricolor. We're certainly going to see that happen from time to time. But the regional banks, in our view, also should be reporting good quality credit as well as we go forward into the reporting season this week.
Because I know you cover Fifth Third as well, that tie-up with Comerica. Gerard, are you focusing on seeing more of the same from the regional players into year-end? We've talked lots about the deal flow, but within the deal flow, the mergers and acquisition story is getting a little bit more interesting for the banks.
John, it really is. And if you start to see rates continue to come down, one of the obstacles to getting more deals done is the marks that the buyers have to put on the seller's assets. And as you recall, many of the banks bought bonds and made loans back when rates were much lower in 2020 and 2021. As those portfolios burn off, and if rates come down further, that obstacle goes down, which makes deals, even more attractive. So yes, as you and I have chatted in the past, back in the 80s, we had 18,000 banks and thrifts. Today, we're down to about 4,300. M&A activity ebbs and flows, and we expect over the next 12 months, you'll see a real pickup within the banks, more mergers and acquisitions, especially if rates continue to trend down.
A sign of things to come. Gerard, you're going to stick with us. Gerard Cassidy of RBC. We'll have more from Gerard in the next hour. Get numbers from Citi in about 20 minutes' time, following record third quarter revenue from Goldman Sachs this morning, and almost, I stress almost, a beat across the board.
I mean, honestly, the only one point where you didn't see a beat was in equities trading. Everything else pretty much across the board. Net interest income came in at $3.85 billion versus the estimate of $2.87 billion. So almost an entire $1 billion in addition to what people were expecting. The EPS was $12.25 versus the estimate of $8.40. It really goes to the question, is Goldman Sachs highly leveraged to the cycle of capital markets and what we're seeing in terms of deal activity, as well as high net worth individuals? So they're not going to see the weakness. How translatable, how transmutable are these types of earnings to, say, the smaller banks, to some of the more regional players, as well as to private credit, which is more connected to the underlying economy?
The stock is a little bit softer this morning, but that stock has had quite a run for 2025. Goldman Sachs so far this year, before today, year to date, up around 40%. Big move for the year so far. Let's get you an update on stories worldwide. Here are your headlines with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. Goldman Sachs shares are lower after the investment bank reported third quarter earnings. Goldman beat on estimates on advisory revenue, investment banking, and saw record third quarter revenue coming in at $15.2 billion, up 43% from a year earlier. Global deal values topped $1 trillion for just the second time on record, boosted by a slew of major transactions in the quarter. Elsewhere, the US has begun collecting tariffs on imports of lumber and timber at a rate of 10%, as well as on cabinets, vanities and upholstered furniture at a rate of 25%. The moves, which went into effect at 12:01 a.m. Tuesday, threaten to raise renovation costs and deter new home purchases. Currently, roughly 7% of all goods used in new residential construction come from foreign suppliers. And President Trump hosting Argentinian President Javier Milei today. The White House expected to announce a $20 billion lifeline to prop up the South American country's economy. This after the US Treasury began to buy the Argentine peso to help stabilize the economy and bolster support for Milei. Milei faces a midterm election, of course, later on this month. And that should be my brief, John.
Lizzie, thank you. More from Lizzie next hour in about 30 minutes' time. Up next on the programme, the case for cutting.
The FOMC's decision to cut rates by 25 basis points in September made sense. Over the rest of the year, I view easing along the lines of the median SEP policy path as appropriate.
A few more days of Fed speak before going into the blackout, the quiet period. Chairman Powell delivers an address later on this afternoon. We'll break things down with Herr of JPMorgan. Live from New York City, you're watching Bloomberg TV. Live from New York City, welcome back to the programme. Equity futures on the S&P 500 just a little bit softer. Big day ahead. Includes Chairman Powell later on this afternoon, 12:20 Eastern Time. More earnings coming up later. Numbers from Citi in about 14 minutes' time. Numbers from the bank so far so good. The equity market, though, is failing to get a lift. The mood isn't changing. Equities down across the board. We're down by 0.9% on the S&P. On the Nasdaq, we're down by a little more than 1%. The only good news I've got for you is that we are off session lows. In the bond market, that rally holds. Had a rally on Friday, closed on Monday, and the move sticks. Yields are down by about 2 basis points, 4 on 10s, and briefly a 3 handle on a 10-year maturity earlier on this morning.
So I guess the real question here is how much comfort can investors get from the idea that developed market government bonds are acting in the way that they traditionally do, which is as a risk-off haven. Is that really something that you could take forward, or is this sort of a momentary knee-jerk reaction at a time where people have a lot of money sloshing around and are looking to put it somewhere?
Very different to the price action of April.
Yes.
I know we've said that a few times, but the risk aversion of April, we were selling bonds too. That was kind of scary at one point. We're not seeing that. over the last week.
And I don't know how much it's the revenues coming in from tariffs. I don't know how much it is concerns that Jamie Dimon represented when it came to the labor market softening. I don't know how much it has to do with Federal Reserve officials that are going to be cutting rates and trying to support bond markets no matter what. There is this question about how sustainable this is, and I think that really is what we're going to continue to ask.
Let's turn to the Federal Reserve. Under surveillance this morning, the case for cutting.
Labor market risks.
So here's the latest this morning. Some problems with that sound, obviously. Chairman Powell getting ready to speak, just not quite yet. A full day of Fed speak ahead with Fed Chair Jay Powell speaking at 12:20 Eastern Time. Herr, the US Global Fixed Income Currency and Commodities CIO at JPMorgan Asset Management, writing the following. Despite the absence of government data, the Fed is on track to deliver another risk management cut at the end of the month, in line with market pricing. Kate joins us now for more. Kate, good morning.
Glad to be here, John. Thank you for having me.
Thank you very much for being here. So no strong case to deviate from the dot plot. When do things get harder for this committee?
So it's an interesting question, and let's take a step back. First off, I think every time I've been on Bloomberg, I've been here to comment on a piece of economic data. CPI, jobs numbers, there's always data. So it's kind of interesting to be here this morning without a data that you want an immediate comment from me on. It's kind of actually a little more relaxing.
Okay, I'm struggling too. And I think it
You're
gets
just
awkward.
making it up, John. It's fine.
I make it up every day. Don't worry about it, Kate. I worry about this Fed at the end of the month because it could be uncomfortable for them. They might not have payrolls. They will have CPI. And CPI might have a 3 handle. Now, you expect that rate cut, but how uncomfortable is that rate cut with inflation around 3%?
So look, I think if we go back to August, and obviously Powell's speaking again today, but we go back to August, Chairman Powell made very clear that his primary focus is the labor market. And while we have not received yet non-farm payrolls, and it's unlikely that we will get them before the Fed meets at the end of this month, the data that we can see, like the Indeed job opening type data, any type of survey data, continues to indicate that jobs are harder to find. And I think with the Fed's focus on jobs, they continue. They cut 25 basis points in October. They cut 25 basis points again in December. They cut 25 again in January. That's our base case.
Does that make you like long bonds here with the 10-year at 4%?
Yeah, in terms of long bonds, yes, we have been modestly short duration. We've had a view for a while now that the 10-year is going to stay in a range between 3.75 and 4.25. As John observed, 10-year has struggled to break through 4 on technicals. It touched it this morning, behaving, as you noted earlier, in a classic, risk off back to bonds. So candidly, as a bond manager, as a bond PM, it's kind of nice to see bonds doing exactly what they're supposed to be doing at this point.
I'm struggling with this idea that we can have asset price inflation. We can have a part of the consumer doing incredibly well because of the wealth factor, because of the stock market, as well as the fact that they're getting paid more and they're getting paid better, that we can have all of that without inflation, even if you do have a cohort of the labor market that's flat on its back. How do you reconcile those two things?
You raise a great point, and I think to quote the big boss back at JPMorgan, there's an awful lot of money sloshing around. And I think that's exactly right. There's an awful lot of money sloshing around, and that's what's driven equity price appreciation in various things. Inflation's a little bit trickier. When you think about inflation, what are the primary drivers of inflation? You get inflation from wages. We have not seen any wage inflation. I'm not talking about the next CPI print that we get. Undoubtedly, that will be a hot number because we've got effects from tariffs. But when you take a step back and think broadly what drives inflation in the U.S. economy, it's wages. Like I said, the wage data is the labor market is clearly showing signs of weakness, so no signs of wage inflation. You look at rent inflation. There's been an awful lot of supply that's come on. The housing market continues to remain weak. We don't see long-term structural rent inflation. And then thirdly, it's inflation expectations. Those also have remained relatively contained. So near term, yes, I think you'll start to see the impacts of the tariffs. But longer term, it's hard to make a case for high sustained inflation, given the weakness in the labor market and the weakness in the housing and rental markets.
But Kay, how uncomfortable is it going to be for the Fed to cut, knowing potentially they're going to have a hot CPI print, because we will get the CPI report. But as you said, we're probably not going to get the labor market report. Jay Powell says he's data dependent, and the only data he's going to have going into this is potentially hot CPI.
I think they'll go back and look at some of the real-time data, so that some of the survey data, and the survey data, whatever you're looking at, continues to indicate that jobs are harder to find, and there's there's not as much people quitting jobs. I think the other thing that they're going to get, which is going to be a focal point for the next three weeks, is earnings. As you noted, earnings have started in earnest today, and I think there's going to be a big focus on margins, on what companies are doing in terms of passing through the tariffs, but also what companies are doing with the labor force. So I think that'll be things that they'll focus on.
Neil Datta agrees with you. He writes in from Renmark. He says the following: the labour markets are slowing, oil is coming down. Worrying about inflation here just demonstrates how off the reservation some of these officials are at these central banks.
Well, okay, maybe that's the case. And I hear that a lot of people agree with him, and I understand the case. I can also understand the case on the other side. When you see the earnings, the likes of what we've gotten from the banks, when you see the asset price inflation, and then you see the fact that some people are willing to pay $14,000 for a first-class ticket over to Zurich at a random time, you start to wonder, at what point are we looking at asset price? I think
it's more than that.
But yeah, I would just like to go on the record that I'm not going to Zurich, and I'm not flying first class anywhere. I'm not sure where that came from. Maybe that was the last person that was in this seat.
I'm just curious about at what point asset price inflation translate to either real world inflation or a deflation in the asset prices. I just think that there might be some sort of disconnect.
I think Lisa's projecting just a little bit. I think possibly, maybe. Is that you doing a search for next year? Right?
That's
14,
literally the cost of...
It's
anyway.
more than $14,000.
All right, let's move on.
Why Zurich? Move, someplace else.
That's
exactly.
You buying gold in Zurich? Is that what your angle is?
Exactly it. But
now we're tying everything together. I now see the increase in the gold prices.
About the asset price inflation and the debasement of the currency leading to a broader-based inflation in the underlying economy.
So let's take it back to earnings. I think the real drive...
Thank you, Kay.
The real driver of asset prices is the underlying earnings. So I think the real focal point right now should be on earnings. What are sustainable cash flows, and what are the multiples that people are willing to pay for those?
So in public markets, the large companies are printing money and doing really well. In private markets, we're seeing some signs of stress. How are you thinking about the distinction you would draw between some of the credit stress we've seen in private markets and what you're seeing in public markets?
Yeah, I think the interesting thing is that increasingly the distinction between public and private markets is blurring. If I think about my career in the financial markets and fixed income markets over the last 26 years, there used to be a very clear delineation. This is public, this is private. What we've seen over the last decade, really, over the last 5 years in particular, is the blurring of those. Private equity sponsors, they don't really care whether they're borrowing in the levered loan market, the high yield market, or in the private credit market. So I think there's a blending and a blurring of all of those. So I do think, we have started to see some credit. I would call them at this point idiosyncratic. Is there a theme on them? There seems to be a theme of some fraud, some possible fraud. Back to Lisa's earlier point, I think when you see so much money sloshing around, it's not uncommon, late cycle at this point. I don't want to bring up shades of 1999, 2000, but if you go back in that era, that was absolutely a time of corporate malfeasance. So I think that's something to watch for. And I think you make a great point. Overall, in large cap S&P 500 land, earnings are strong, cash flow is strong. We've started to see some weakness and cracks in other pieces of it. It remains to be seen. It looks like, I haven't looked at this morning's earnings closely since I was here prepping with you all. But so far, it looks like credit quality remains pretty strong. It looks like loan growth is growing in those markets. So, maybe just idiosyncratic. But I think, as you all know, when we're managing bond portfolios, some people might make it seem exciting that it's about what the Fed's doing, but there's an awful lot of bottom-up individual security analysis, and that's really where we're focused right now, John.
We try and make it sound exciting anyway. Kay,
it's really not, John.
Kay Herr of JPMorgan from New York City this morning. Good morning. The third hour up next.
For many investors, there aren't that many alternatives to the U.S. market.
There has been so much complacency within the market.
There are going to be pullbacks. Those could be buying opportunities.
Markets are just still so focused on AI is great for the long term.
This market is really going to get its mojo going forward from earnings.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. On the S&P, up by, or rather down by 0.8% on the S&P. On the Nasdaq, we're lower by more than 1 full percentage point. On the Russell, we're negative 1.25. That screen reflects the tension between the US and China. But check out the banks. We've had a lot of beats on Wall Street so far this morning. From Wells, from JPMorgan, from Goldman Sachs. Higher almost across the board, particularly for Wells Fargo, up by 2.6%. Citi, the latest. And we've got another beat, Bramo, this time from Citigroup.
Yeah, beat across the board. I mean, if you take a look at their fixed sales and trading, it's $4.02 billion that was the revenue coming in versus the expectation of $3.74 billion. Markets revenue came in at $5.56 billion versus $5.97. We can go through all of the numbers. The takeaway here is it's beating across the board in the banking sector, as well as the personal banking revenue, as well as asset management, firing on all cylinders at a time where the banks seem to be operating in a world of their own. High expectations and still continuing to exceed them.
Citigroup up by 0.8%. In the last half an hour, the last 30 minutes, Goldman Sachs with record third quarter revenue, Citi revenue beating in every single division. With the details, let's cross over to Scarlett Fu for more. Hey, Scarlett.
Hi, John. Yeah, I'm taking a look at these numbers, and it's a solid beat across the investment bank and markets business, as we've seen with most of the other banks as well. For overall markets revenue, $5.56 billion, higher than the anticipated $5.07 billion. Fixed sales and trading, $4.02 billion. Analysts were looking for just under $3.75 billion. Equity sales and trading revenue, $1.54 billion, also higher than the anticipated $1.33 billion. And investment banking, which is a smaller part of Citi's business here, $1.17 billion, higher than the anticipated $1.05 billion. So FICC was a real standout here for Citi, which was anticipated. Just looking at the numbers here, the CFO, Mark Mason, had been giving indications that perhaps the firm was maybe backing away from its explicit cost targets for the full year. So we did get an update on that. It says it sees full year expenses higher than $53.4 billion. The stock right now is still trading a bit higher in after hours, pre-market trading at the moment here. Citi, of course, is still targeting a return on tangible common equity of 10 to 11% for 2026, so that profitability measure does remain intact. In terms of the return of cash to shareholders, Citigroup bought back $5 billion of its common shares in the third quarter as well, and it still sees a full year adjusted revenue of above $84 billion. So again, a lot of question marks here when it comes to the outlook for expenses and revenue for this year after the CFO, Mark Mason, had given an indication that perhaps the firm would be emphasizing other metrics and not so much the actual line for total expenses. We'll continue to go through all these numbers right now, but one more thing I wanted to add on is Banamex situation, the Mexican unit that Citigroup is trying to sell. Of course, it did reject an offer from Grupo Mexico, and it did announce sales an attempt to sell a 25% stake. It says that it continues to work towards a planned public listing of the firm. The big question is, when will that happen? Will it be delayed until late 2026 or beyond?
Scarlett, thank you for breaking it down. More from Scarlett Fu later this hour. Here's the statement from Jane Fraser of Citi. The cumulative effect of what we've done over the past years, our transformation, refresh strategy, our simplification, have put Citi in a materially different place in terms of our ability to compete. The stock is higher this morning on the session by a little bit, on the year by a lot. Citigroup is up this year by close to 40%. Similar story for Goldman. JPMorgan's higher by 30%. This has been the issue for me so far this morning, Brammer. How much of this morning is new? The numbers are great, but this story is well understood, and it's reflected in the rally we've seen so far year to date.
Which is the reason why people said they've got a very high bar to beat. And guess what? They did. And they raised it. And so this is the question. How much more is there in the pipeline? This is why we're all going to be listening to understand exactly how big the pipelines are for the fourth quarter and beyond, how predicated this is on an ongoing strength in the consumer. And for Citigroup in particular, because they are so global, they are such an international, transcontinental kind of bank. What kind of flows are there at a time of rising geopolitical stress? Are they seeing that in terms of their banking, or is that encouraging people to take more action to diversify into other regions?
Let's stick with the earnings this morning. Matt Stucky of Northwestern Mutual Wealth Management writes in the following: the scarcity of earnings growth that for the past few years was only found in large cap tech can also be found across a variety of segments of the market. Matt joins us now for more. Matt, I guess just to build on the conversation we've been having, does that include the financials, the big banks on Wall Street?
Well, it certainly does. And thank you for having me again. Good morning. Just looking at the numbers for JPMorgan that were reported just a short while ago, you're talking mid-teens to 20% plus in terms of trading revenues. And then if you add into that just the continued health of the consumer, at least JPMorgan's consumer, driving credit and debit card spend up 9% in terms of volume year on year. That is very healthy top line revenue growth. Again, to my earlier comments that I sent over, it's not just a Mag 7 environment anymore. Certainly those companies are continuing to be healthy, but you can look to other parts of the market still and see pretty attractive top line growth.
Matt, it's been really impressive to see the deal activity of the past few months. Fifth Third got to get together with Comerica. Biggest leverage buyout in market history announced in September. Paramount still going after Warner Brothers. Matt, is this just a feel, a sign, a sense of things to come for 26? That's certainly the conversation we had earlier on this morning. Is this more than just pent-up demand? Is it something bigger than that?
Well, I think it's a reflection of market conditions to a certain extent. You're looking at high yield credit spreads kind of near 25-year tights, and that opens the M&A window in addition to a change in the administration from last November. And so companies are seizing the moment, and companies like JPMorgan, like Goldman Sachs, as we're seeing this morning, are capitalizing on that environment, kind of really generating healthy top line growth in those fee-based businesses. So, it's a question of whether or not, a company has a strategic rationale for expanding through the M&A window, because it certainly is open to them at this moment.
We used to extrapolate out from bank earnings to the rest of the earnings season and sort of a tone to the overlying economy. Can we still do that if some of these deals are driven by low credit spreads and financial conditions that seem increasingly divorced from what people talk about in the labor market and other pockets of select credit weakness?
Well, I think the nice thing about bank earnings coming first in the earnings season is you do still get a pulse on the consumer. And in the absence of government-related data kind of being shut off, at least for the time being, it's a somewhat comforting reminder that if you look at the credit quality of the banks that are coming across the wire this morning, that things look fairly benign in terms of their own kind of credit experiences. Specifically here, if you're looking at charge-offs for JPMorgan, down year on year, down quarter over quarter. And so some of this labor market weakness that, has really captured the attention of policymakers really isn't impacting the credit performance at this point for banks. And it's still also reporting, pretty healthy consumer spend levels at the aggregate level. And so, I think if we're looking just at, the investment banking activity, that can tell one side of the story, but there is a consumer update that comes with bank earnings reports that I think is really valuable in the vacuum of very little economic data rolling across the wire.
We're seeing it not have that big of an influence on equity futures this morning. They are lower, and it has to do with the geopolitics of the moment, the escalating tit for tat between China and the United States. I just wonder if there is enough momentum in the underlying consumer that you're sussing out from some of these earnings to give you confidence to buy a dip, right? To go in if there is even a modicum of a sell-off in the face of geopolitics.
Well, I think dips probably we should talk about those as more in the 5 to 10% category, not the 1 to 2% category. And so I think if we're looking at the market setup here, certainly earnings are strong, but valuations are also very high. And I would say market psychology, just in terms of kind of what's been driving markets higher post-April, has been a risk on sentiment, with some areas of the market, that have little to negative earnings kind of really leading the performance of the market. And so to me, I would say risk appetites are pretty full on the part of the investor. And so, that's not necessarily the dip buying kind of mentality that you want to charge into until some of those excesses start to burn off in the market.
Are you basically saying that potentially this quarter, the next few weeks, could be driven by the geopolitical headlines, less so the earnings, because the rhetoric has gotten so hot and the valuations are so high?
Yeah, I think that certainly is potentially, something that we need to watch out for. Just look at kind of what aggregate risk is priced into financial assets here. We have credit spreads near 25-year tights. The market's trading 22.5 times forward earnings, kind of near the top end of the range for the last 5 years. And so it doesn't take a whole lot of incremental risk to be added into the equation for that to find its way into security pricing. That being said, earnings trajectories look stronger than any point in the last couple of years, at least from a broad scope if we're looking at things like large caps, small caps, mid caps, all looking at earnings revisions pointing up and to the right. And so it's been a better earnings backdrop to probably navigate maybe some incremental headwinds from the geopolitical perspective, but certainly, from a pricing perspective, any kind of wobble in terms of the geopolitical outcomes as we head into those negotiations could affect asset prices.
I guess, is it an opportunity to buy before the sit down, or potentially you want to know what the news is of the sit down after?
It'd be really difficult probably to say, the outcome of that conversation more than the incremental investor. And so to me, I don't think you kind of position a portfolio with little to no edge going into that decision. I think you just stick to kind of what your overall portfolio is and continue to kind of use diversification as the way to navigate, a lot of headline risks that might be coming between now and then.
Matt, appreciate it. Thanks for jumping on, sir. Matt Stucky there of Northwestern Mutual. Following the latest on the banks on Wall Street, really, for many of us, earnings season begins 2 weeks tomorrow. Meta, Microsoft, Google. That's at the beating heart of what's happening, not just in this market, but also the broader economy at the moment as well. So you've got to wait a few more weeks.
That is the GDP story right now, is the AI spend, and how much does that continue to really beat and raise. That's really going to give us a sense of how long this rally can keep on going, regardless of what goes on in terms of the geopolitical noise.
Then you get numbers from NVIDIA in like 10 years.
November 19th.
Yeah.
2027.
Basically Thanksgiving.
I know. It's ridiculous. I wish they'd bring it forward, but they've got their own reasons. OK, let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. Citigroup beat Wall Street estimates across all 5 major business lines. Total revenue jumped 9% as multiple divisions set record for a third quarter. Expenses also climbed 9%, part of that coming from higher spending on compensation and on benefits to lure a wave of bankers recruited to bolster deal making. Now, services and US retail banking units both had their strongest quarter ever. Elsewhere, Fed Chair Jerome Powell is set to speak today before the National Association for Business Economics in Philadelphia. It's his first major public appearance since the policy meeting last month, which, of course, exposed deep divisions among Fed officials. Meanwhile, Philadelphia Fed President signals she favors 2 more quarter-point interest rate cuts this year. And the International Energy Agency is expecting a record oversupply of oil next year. The agency expects world oil supply to exceed demand by almost 4 million barrels a day by 2026. The anticipated oversupply comes as OPEC Plus and some of its rivals continue to boost oil output. And that's Bloomberg Business Flash. Your Bloomberg brief, John.
Hey, Lizzie, appreciate it. Lizzie Burden, thank you. More from Lizzie in about 30 minutes' time. Just tracking a media call for JPMorgan, the CFO, Jeremy Barnum, being asked about what's happening in private markets and the exposure to things like First Brands, Tricolor. Didn't have exposure to First Brands, good news. Has a $170 million charge-off for Tricolor. You can see where the attention's going to be, the spotlight on the earnings calls in the next few hours.
How much of this credit quality worthiness is going to be called into question as a result of some of the recent hiccups? And how much does really the point that Kay was making really remain relevant, which is when you have frothy markets, you get malfeasance, you get fraud, you get things that happen in funny ways, and how do you really reduce your exposure?
And a lot of that's happened in the dark, with little transparency. S&P 500 futures negative here by 0.8%. Up next, the morning calls plus Gerard Cassidy of RBC as we recap the latest round of bank earnings. Earnings season on Wall Street commences.
I think it may be a little bit of a spookier October. I think earnings continue to be the North Star. As I look at the overall market, you're just seeing some minor cracks. We still think we're in a bull market that deserves the benefit of the doubt. But, I think this turbulence is likely to continue through this month.
3 years into this bull market, an 80% plus rally, trillions of dollars of wealth created over the past 36 months. Equity futures on the S&P 500 negative by 0.9% this morning. On the Nasdaq, we're down by 1 full percentage point, dominating today's trading. In fact, dominating the trading of the last 3 sessions. This tension between the US and China.
Absolutely. And the latest call out basically from the Treasury Secretary saying that what China is trying to do when it comes to rare earths is bring down the entire U.S. economy. And what we have this week is more basically targets when it comes to hot rhetoric and what they plan on doing when it comes to ships. Last week it was rare earths. All of this before the two leaders are set to meet. Is there enough time to basically put a lid on all of these issues? That remains to be seen.
Stocks down, bond yields lower. We're down by 1 basis point on 10s to about 4%, down 2 on 2s to about 350, just sub 350 at the moment. Herr of JPMorgan on the programme about 30 minutes ago, just making the point that this is, I guess, comforting, the fact that bonds are doing what they're meant to do.
Well, if you're a bond investor and you're looking to weakness in the economy as providing a support to bonds, then this should give you some confidence. That said, the rally isn't that significant on the long end. So if you're going to be bearish in any way, which some people might be, you would look at something of a, bear steepening, and that would be sort of what's going on.
Some people,
technically.
Got to find something, haven't you? Just like that little
Well, you have to find the contrarian trade.
I'm with you.
There is this question of how much this is buyable versus something that just is momentarily, that's a knee-jerk reaction.
The negativity, but all right. That's the price action. Let's get you some morning calls. First up, Wolf Research upgrading AMD to outperform, saying it needs to, quote, simply execute after its OpenAI deal. Next up, Bank of America cutting its price target on GM to 61, expecting lower North American volumes. And finally, Piper Sandler raising its price target on Schwab to 100, optimistic on the overall health of retail traders. And the number one performer on the S&P through most of this year, Robinhood. It's just been flying.
And frankly, the retail investors have been bullish, and they've been the ones that everyone else, the institutions, have been chasing. And they've gotten it right. They've gotten rich. And frankly, the people who haven't been in the market have been the ones that have lagged behind in the spending and in the earnings. So at a certain point, success begets success.
True. And they've been successful, that's for sure. Let's stick with the financials. Big banks kicking off earnings season today. JPMorgan edging lower despite the bank boosting its net interest income forecast for the full year. The CEO, Jamie Dimon, said in the release, while there have been some signs of a softening, particularly in job growth, the US economy generally remained resilient. With a recap of the earnings this morning, here's Scarlett Fu with more. Hey, Scarlett.
Hey, John. Yeah, JPMorgan, Wells Fargo, and Goldman Sachs all reported their results a few minutes early. Maybe they were super excited to get their numbers out because the setup into this earnings season is that the big banks would beat and raise, especially for JPMorgan and Goldman Sachs. But you look at how they're performing in the pre-market trade right now. JPMorgan and Goldman Sachs shares are lower, perhaps because they were seen as the big stars and they had gained so much, outperforming the broader market and their peers. We already got some indication that the results would be solid on the investment banking and trading front because of Jefferies' results. Jefferies posted its best third quarter ever thanks to an explosion of M&A. We saw M&A globally top $1 trillion in the third quarter, only the second time ever. And that boom creates a multiplier effect where you get equity financing, debt financing, hedging, divestitures. So to that point, Goldman Sachs investment banking fees rose 42% and advisory fees surged 60%. JPMorgan had guided the investment banking fees to double-digit year-over-year increases. It delivered on that. The standout really when it comes to FICC trading was Citi coming through with an 11% jump to $4.02 billion and JPMorgan reporting a 21% increase. On equity trading, Goldman Sachs actually missed by a little bit. JPMorgan rose 33%. What's interesting, of course, is also the third quarter tends to be kind of seasonally slow, but because of all the excitement over what's happening with the deregulation and the AI trade, the activity has been certainly very, very robust, and that has translated to better revenues and profit for these big banks. In terms of the net interest income, which is the difference between what banks earn on loans and pay for deposits, their bread and butter, as you mentioned, John, JPMorgan did raise its full year outlook by about $300 million, but for the third quarter, its net interest income did miss ever so slightly. Of course, investors and analysts are perusing through, scrutinizing these reports for any indication on what these banks say about credit quality, about consumer and corporate confidence, especially because there's no economic data right now because of the government shutdown. Jamie Dimon was fairly cautious. He usually is in his comments. But having said that, the numbers really speak for themselves. And because of the big gains in their share prices, you're seeing a little bit of pullback in the star performers.
Scarlett Fu with the latest. Scarlett, great work this morning. Tremendous as always. Gerard Cassidy of RBC Capital Markets back with us for a final word on things. Gerard, so today we've heard from JPMorgan, Goldman, Citi, Wells Fargo. Tomorrow, Morgan Stanley and Bank of America. What have we learned this morning, and how does that inform your view of what we can expect tomorrow?
John, I think what we should expect tomorrow is the fact that the trading results for Morgan Stanley and Bank of America will likely mirror what you saw today from the big banks, which were very good. The FIC numbers in particular year over year were strong, and we anticipate that we'll see that for the others. Also, the investment banking results, as you've pointed out already earlier in the show, were also strong, and we should expect that as well for Bank of America and Morgan Stanley. And then finally, on Bank of America, since they've got a real deep dive into the consumer numbers we've seen today, whether it was JPMorgan, Citi, or Wells Fargo, all were resilient, and we would expect Bank of America's numbers to be resilient in that area as well.
And on the call that John was mentioning, JPMorgan called the CFO of that bank saying that he's not really seeing any cracks in the credit market aside from a couple of idiosyncratic areas, and says that for investment banking, all drivers are pretty much in place. I do wonder, though, that what we heard from the Wells Fargo on their call is that middle market clients are still cautious on borrowing. How much do you expect the success to be mirrored in smaller and mid-sized banks that are going to report that might be more leveraged to those middle market clients?
It's going to be interesting, Lisa, because certainly Wells has got a good read on the middle market of the U.S. It's predominantly a U.S. bank. And the regional banks, though, could also benefit from the fact that the capital expenditures that we're anticipating due to the big, beautiful bill that was passed in July, with the depreciation of 100% of those capital expenditures in year one, could drive commercial and industrial loan demand. It's interesting to note JPMorgan's loan growth year over year was 7%. Wells was much lower, closer to 2%. So I think what you're going to see is that Wells is still coming out of that asset cap. It's going to take time. They have indicated that. And so I think the read to the regionals is still positive based upon what we saw from JPMorgan's loan growth.
Gerard, I know that you probably don't want to pick favorites or winners, but so far it is early. Who do you think is winning the earnings season right now?
Of the four that came out, obviously JPMorgan's numbers were very strong across the board. So you probably have to put them up at the top of the leaderboard. Citi's numbers were also very good. They had a higher tax rate, which on a bottom line basis impacted EPS. So you'd probably put them up second. And then, the other two, Goldman and Wells, are tied for third. There's gold, silver, and bronze for everybody.
Gerard, thank you. Appreciate it. Gerard Cassidy of RBC. Tremendous to have you with us throughout this morning, breaking down the numbers from the likes of Goldman, JPMorgan, Wells Fargo and Citi. We don't have data, we've got earnings. And in those earnings, if you're worried about the consumer, I know this is not a broad view of the US economy. Certainly the likes of Delta captures the upper income earners, but so far pretty decent. Okay, it's not reflective of any kind of freak out that you might have seen off the back of a massive step down in the payrolls growth that's developed over the last year.
If the big banks saw a real issue with credit concerns, they would have increased their credit loan loss provisions much more than they did. And what you're hearing in the commentary is not a lot of concern about some sort of rapid deterioration. So far, those warning signs just aren't coming out in the way that you would expect if we really are about to fall off a cliff.
It's an overused phrase, I know, and we've been using it repeatedly since the pandemic, but the K-shaped economy. Yesterday, we called it the Delta Airlines economy. It's what it feels like. It's what you see in the data. It's what you see in the earnings.
I just wonder how sustainable it is. I mean, I don't want to go all, societal,
sure,
but there is that question. There's also this question of, does the upper income drive inflation for the rest of the economy?
Up next on the programme, we'll catch up with Joe Davis of Vanguard as he's expecting just one more rate cut. Plus, Yahira Anand with your morning movers. The blockbuster AI deals keep coming. Just check out JPMorgan in the pre-market. Just wanted to give you a sneak peek of what's happening on the earnings call, at least in the last 20 minutes or so. A lot of interest in what's happening with the elevated credit cost figure over at JPMorgan. And JPMorgan being very transparent about the situation, saying that contributing a $170 million charge-off was the issue with the subprime auto lender Tricolor Holdings. Jeremy Barnum, the CFO, had this to say: "We're not in the habit of calling out exposures to individual borrowers, especially for amounts that are quite immaterial, but it's getting attention, so, quote, we might as well not dance around it." I think Jamie Dimon, the CEO and chairman of JPMorgan Chase, saying not exactly our finest moment.
Yeah, really being pretty open about this, and it explains why their credit loss build was greater than other banks relative to expectations. It also is interesting, they went on to say this is not something they're seeing in a broader credit market issue. This was a couple of bad actors and that they're going to continue to be vigilant. But it does speak to that loan loss builds that otherwise seemed out of sync with the rest of the banks.
Quote, "We do not have any exposure exposure to first brands. There's nothing more. But these banks are going to get questions about what's happening with those credit events in private markets over the last few weeks. And I imagine we'll get similar questions tomorrow on earnings call with regards to the other banks.
Well, to build on that, and it isn't just with respect to these names, Jamie Dimon also did comment on private markets and concerns there, saying not seeing it yet, but saying that he is worried about transparency. The lack of transparency in private credit will become an issue, particularly, he said, if it goes retail. So clearly there is a greater degree of attention being placed to this. I also want to point out one other thing. And I noticed this as I was digging through the results. Their headcount rose from last year. So they're talking about AI taking over all these jobs. You know, maybe not. Their headcount actually went up a little bit year over year.
They're leaning in
yes.
to heightened client activity. Let's put it that way. Equities, if you're looking at stocks this morning, of course, we're lower by 0.9% on the S&P. We are off session lows. We're still down on the Nasdaq by 1.1%. The tension between the US and China coming back to the surface started on Friday. Felt like we backed away on the weekend, but only really one party backed away over the weekend. So when we bounced on Monday, we didn't take back all the losses of Friday. Then again this morning, just more details of China just tightening the screws a little bit, positioning for leverage going into talks at month end.
Yeah, new port fees on U.S. ships is what we got today out of China. This matches what the U.S. was doing as well when it comes to Chinese shipping. Last week it was about rare earths. And on top of this, you have the Treasury Secretary speaking to the Financial Times, talking about some of the context of what's going on in these trade negotiations. And really, he was really rough on China, saying they're in the middle of a recession or a depression, and they're trying to export their way out of it. The problem is they're exacerbating their standing in the world, meaning what they are doing when it comes to rare earths is not just going to hurt the United States, but it's going to hurt all of the trading partners as well.
That's a tailwind for the bond market so far this morning. Yields are lower across the board. We're down by 2 basis points on 10s, just north of 4% on 2s, 347. That's the cross-asset price action with some single names into the opening bell, about 58 minutes away. Here are your morning movers with Yahara Anand. Hey, Yahara.
Hi, John. We have our latest AI deal, and it is a big win for AMD. Oracle plans to deploy 50,000 of AMD's new MI450 chips in data centers starting in 2026, just highlighting the race to build more AI computing power. The deal positions AMD as a growing rival to NVIDIA amid this push to meet the soaring demand for compute power. As I said, AMD shares rising 2.3% on that news. Meanwhile, moving on to banks, corporate deal making is back, and you can see it in these results. Wells Fargo shares are up 3.2%. While it's not a big player in the space, Wells Fargo posting higher than expected investment banking fees, though net interest income did come in slightly below estimates. Meanwhile, Citi revenue, it beat estimates on revenue across all 5 of its major business lines, while Goldman Sachs posted record third quarter revenue on trading and investment banking, but those shares down 2.6%. And we are seeing rare earth stocks extending their gains. Look at critical metals up nearly 35%. Now, I will note USA rare earths up 11%, MP Materials up 8%, on track for 4 straight days of gains. The sector has been surging ever since China tightened its export controls on these rare earth minerals, and with every escalation since, including that one overnight by Beijing. John?
Yahara, thank you. Thanks for the update. The rally in that space has been unreal. Phenomenal. The opening bell just around the corner. Let's turn to the Federal Reserve. Jerome Powell set to speak at the NABE annual meeting in Philadelphia later on today. Mike McKee's on the ground and has more. Mike, thanks for joining us and making time for the program. In mid-September, the Federal Reserve met, and since then they've been light on economic data. What more can Chairman Powell add later on this afternoon?
Well, that's the question of the day, John, because, of course, Jay Powell has taken both sides of the issue so far. Here's what he said a week after the Fed meeting. The last time we heard from him, he said near-term risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. Two-sided risks mean there is no risk-free path. Well, that's what folks on Wall Street would call MODO, master of the obvious. And since Jay Powell has to basically lead the Fed, you got to figure out where he's going, or he's got to tell us where he's going, because Friday is the day that night the Fed blackout starts. And even though we're going to get the CPI numbers next week, the Fed will be in blackout. We won't know what they think about them. And this is a very divided Fed. If you look at what members of the Open Market Committee have been saying since the last meeting, you've got Myron Paulson Waller Bowman Daily, the usual suspects on the dovish side, and you've got just as many on the hawkish side. It's those who are cautious in the middle who could go either way, and we don't know which way they're going to go. Goolsbee and at this point, Philip Jefferson, along with Musalem, and Michael Barr are the voters. Where does Jay Powell lead them? That's going to be the question of the day. And you made a good point earlier in the show, John, about Jay Powell is data dependent, but he doesn't have any data. So what's he going to say? That's going to be the big question today.
It's going to be very interesting, Mike. Looking forward to your coverage later on this afternoon. That speech drops at 12:20 Eastern Time. They're in a tough spot, aren't they? They don't seem to have a consensus on how to move forward at the moment. They disagree or have division around the data we actually have. But then we've got a bunch of data we don't have. And then you could see this situation where they don't have payrolls. They do have CPI, and CPI is around 3%, and they're going to cut interest rates in October.
And then you add on top of this the fact that there's probably going to be new leadership and potentially a new member come early next year. You put all this together and you get this reticence to really do anything that makes waves. I do wonder if there is a reassessment of what the neutral rate is, if we do get some sort of inflationary read that is elevated in tandem with the earnings, whether the earnings take on a renewed interest for some of the Fed officials in the absence of anything else.
Let's stay on the Federal Reserve. Joe Davis of Vanguard writes the following. We expect the Fed to ease once more in 25, with October, that meeting being slightly more likely. Joe joins us now for more. Joe, welcome to the programme. What makes October more likely, given we are light on economic data at the moment?
Well, I think it's just the slowdown we've seen in the labor market. Clearly, there's a number of forces at work. We've seen some supply come down materially over the course of this year. But the fact is, demand and businesses have held back on hiring, too. And so for that reason, our assessment for over 2 years is the Federal Reserve has been restrictive, perhaps not as restrictive as some think. And so this is really getting them to that elusive neutral rate, which no one knows what it is, but I think they're approaching where it should be.
Joe, Mike McKee talked about it, the amount of division on the Federal Reserve. I assume you believe there is a consensus on how to move forward. I'm struggling to identify that consensus given the amount of different views I see in the Fed speak. What do you see?
Well, I think this is actually somewhat typical of the various facets of the economy you could look at. When you're actually close to, let's call it appropriate. I mean, you have a GDP numbers that would, at the margin, say you shouldn't be easing at all. The inflation would point to that as well. But then you got the labor market that would suggest that you got to take a little risk management and ease policy. So I think with that, depending upon how policymakers weight those various data feeds, again, we're going to have a lack of visibility here. I think that's actually par for the course where we're at now.
I just wonder how much they are prioritizing the labor market if they cut rates by another 50 basis points. Yep. I mean, what is the direct read-through to actually supporting the labor market?
Well, I think that's the key issue. And actually, the gap between where GDP is and where the jobs market is, I think is the key issue for the next 6 or 12 months. Because does the gap close? Because productivity is starting to rise, and we'll start to see then a stabilization and perhaps a modest firming in the labor market. That's case A. Case B, though, is that the labor market is symptomatic of weaker growth ahead, and then GDP would come down. That's a more recessionary impulse. We lean on the former, not the latter. But it's explaining that gap. That's the critical policy diagnosis over the next 6 months.
How much is this sort of quietly a Federal Reserve that is aware of the fiscal sustainability of the United States? And I say this with a lot of questions around Fed independence, but this is an issue facing central banks around the world. The idea that there is just so much government debt outstanding that inflation concerns have to be paired much more with fiscal sustainability and paying back that debt than they do, say, anything else. I mean, how much is that coming into play here in the back of some people's minds?
I think it's in the backdrop, but it's increasingly will be in the forefront in the next several years. And you see that in the price of gold, which would seem inconsistent, its rise with the S&P 500. In our framework, it's not. I mean, what we have said for 2 years is that there's going to be this coming tug of war between AI's transformative ability on the positive side, and then if it disappoints, some of the deficit pressures, which again, you're mentioning, you see a little bit of that in the so-called debasement trade. We are just starting this sort of tug of war, and that is how the market is going to play out over the next 3 years, is that tension.
Joe, are inflation concerns going to be more front and center for the Fed at the end of the month, not just because we're going to get the CPI report, but also because the ratcheting up of tensions and rhetoric and sanctions between Washington and Beijing?
Yeah. I think they're still assuming, and I think it's appropriate, that although inflation's been sticky, some of the so-called, dare I say, transitory factors of the tariffs, you have to look through some of that. That was our thesis, that the Federal Reserve would start to ease policy, and it's one of the biggest rationales for us expecting it in October. And I think it's appropriate. I think the Fed will look at, the financial markets, less so gold, but more break-even inflation rates, term premium in the Treasury market. And that's still somewhat reassuring that we don't have a material inflation problem, certainly not what we had in 2022. The key question comes back to, where is the labor market 6 to 12 months in a Federal Reserve that has eased? Then there would be a reassessment.
But when it comes to the recent trade rhetoric and the tit for tat between Washington and Beijing, if we don't get some sort of deal by the end of the month and this bleeds into 2026, how much more concerning does this story become for them? How challenging?
Well, it becomes certainly concerning. Again, this is not a great shock if you're a central banker, if you're an investor to face, right? Because you have downward pressure on growth if tariff goes up, even from the uncertainty, and you push up the inflation rate. So it's clearly stagflationary. It's a sort of card you don't want to have dealt. I think you have a Federal Reserve that's assuming the inflation is more temporary than the labor market. There's a little bit of risk in that assessment, but I think that's fair for now. But the drag into 2026, that would be, I think, unexpected should the trade rhetoric accelerate.
Joe Davis of Vanguard. Joe, thanks for jumping on. Appreciate it. Trying to look over what Chairman Powell might say later on this afternoon without data and predicting what the Fed might do at the end of the month without data. We'll have CPI, by the way, should have it October 24th. The chairman is attempting to lead the committee to one particular perspective around the inflation story, and we saw that at the end of August in Jackson Hole. One off, not all at once. Trying to set up the committee to look through any inflationary bumps off the back of the trade story. And I think we saw that reflected from Anna Paulson yesterday as well, from the Philadelphia Fed, when she said, I simply don't see the type of conditions, especially in the labour market, which seem likely to turn tariff-induced price increases into sustained inflation.
This is the reason why I find it really interesting, in the absence of labor market data, how they can come to any kind of consensus about the other side of the mandate. So maybe it is a one-off. Do they really see deterioration, or do they see an increase in productivity? How much of a read-through can they get from some of the earnings that we're getting right now that speak to a pretty strong economy, and then say, well, that's a different economy than the one that we're facing off with? And then how much do they see any cuts in interest rates and actually benefiting the labor side of the mandate, given the transmission mechanism, which is capital markets, which are wide open? So these are some of the issues that we have to face off with.
I'm right there with you. I think that final point is so important. What difference does it make, given how loose financial conditions already are? Equity futures on the S&P 500, negative by about 1% this morning. There's a weight to the tape this morning, going into the opening bell about 45 minutes away. We'll have an update on stories worldwide with your Bloomberg Brief. Let's cross over to Lizzie Burden for more. Hey, Lizzie.
Hey, John. Alphabet betting big on India. It plans to spend about $15 billion building out an AI infrastructure hub in the southern part of the country over the next 5 years. Alphabet plans to partner with Indian companies with plans to accelerate the AI industry locally. Now, the state plans to host 6 gigawatts of data center capacity by 2029. Elsewhere, AMD shares rising in the pre-market after saying that Oracle plans to deploy a large batch of its new AI chips. Oracle plans to put 50,000 chips in data center computers starting in the third quarter of next year. Oracle and AMD did not say when they expect the installation to be completed. And finally, NVIDIA has begun shipping their DGX Spark chip, which the company calls the world's smallest AI supercomputer, powerful enough to run massive AI models on a desktop. The Spark can be ordered online starting today and will cost nearly $4,000. NVIDIA CEO Jensen Huang kicked off the global rollout by hand-delivering one of the first units to Elon Musk at the SpaceX's Starbase in Texas. And that should be my brief, John.
Hey, Lizzie, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead. Plus, Henry Schwartz of CBOE Global Markets as options traders prepare for earnings volatility. Live from New York City this morning, good morning to all. You're watching Bloomberg TV.
The data that we can see continues to indicate that jobs are harder to find. And I think with the Fed's focus on jobs, they continue. They cut 25 basis points in October. They cut 25 basis points again in December. They cut 25 again in January. That's our base case.
That was the base case of Herr of JPMorgan joining us in the last hour or so. If you are just joining us, welcome to the programme. As we count you down to the opening bell about 42 minutes away, equities are down by 1% on the S&P 500. The tension between the US and China rebuilds. The Nasdaq is down by 1.3%. You see it reflected in the bond market as well. Yields down across the curve. 10s are down by about a single basis point at the moment. Briefly with a 3 handle earlier on in the session. Now 4.02% on 2s, down about a basis point or two to 348.28. As we count you down to the cash open, your week ahead and the next 24 hours shaping up as follows. At 12 p.m. Eastern Time, Fed Chair Jay Powell speaks at the NABE annual meeting. Also today, the Argentine President Javier Milei visits the White House. Tomorrow, earnings from Bank of America, Morgan Stanley and United Airlines. Thursday, a lot of data, all of that dependent on the government shutdown. On Friday, President Trump meeting with the Ukrainian leader Zelensky in Washington. And you get the feeling, after what's developed in the Middle East over the last week, that's the next big push.
Absolutely. This is what the president's focusing on. He actually talked about it as well yesterday when he was in the Middle East, how that is another foreign policy goal of his. So it's pretty critical that Volodymyr Zelensky will be making this trip to Washington. We haven't seen really enough emphasis on bringing Putin and Zelensky to the table since that Alaska summit. And I think the president's going to focus on that now that Gaza has phase 1 done. They're going to still deal with phase 2.
That's the latest on the foreign policy front. Let's turn back to the earnings. Earnings season upon us. Options traders preparing for volatility ahead. Henry Schwartz of CBOE Global Markets writing, most of the increase in dispersion have come from the large cap tech names as investors look to earnings to justify the increasingly high valuation for the sector. Henry joins us now for more. Henry, good morning. Good to see you.
Thanks. Happy to be here.
Before we look ahead, can we start with Friday? The amount of volume that you saw go through and how much of that came from zero-to-day expiry?
So, yeah, Friday was the new all-time record for the industry, 110 million contracts. Okay, keep in mind, before COVID, average daily volume was around 19 million contracts. We'd never seen a day over 50 million. And this year, we've had 2 days over 100 million contracts. So, the industry is basically running at about 21% annual growth. It'll be the 6th annual record in a row. Friday was insane. I mean, and in fact, keep in mind, it didn't even start until 11 a.m. It was actually relatively quiet until then. And then, then word of the 100% tariffs hit and the market fell out of bed. We saw an explosion in volume, which is, and volatility as well. You asked about the zero DTE. That has been kind of the hottest story in the last couple of years. And normally on kind of a high volatility day, the zero DTE crowd actually kind of tails back their activity. But Friday was a little bit interesting, right? Because, this was kind of an unforeseen comment. So the zero DTE volume was kind of already at work. And it was about, in SPX, it was about 61% of the average daily volume, which is a little bit lighter. But, when we see volatility explode and big market moves, you end up basically, that's when the hedgers come in and a lot of positions are adjusted. So that kind of dilutes that zero DTE share.
I think what you identified that was really important about Friday's price action is this wasn't a sign of panic. What you saw in the volumes was actually people start to position for the upside. Were they anticipating what actually happened over the weekend? Ultimately, it materialized anyway.
Yeah, I mean, we've kind of been here before, right? April was a really wild, first half of the month. And I think that is what people were looking for. So, VIX was up about 5 points on Friday, about what you'd expect on a move of, a little bit over 2%. And, we look at kind of exactly what goes into the VIX, right? It's constituted, it's built by a bunch, a strip of SPX 30-day options. So they can all lift or, one side can lift more than others, meaning out of the money puts or out of the money calls. When we see fear and panic, it's the out of the money puts, right? That's what we saw in August of, when the yen carry trade unwound. We saw, a real panic to the downside, although it was very brief. On Friday, we saw everything lift, but we did see that upside call volatility lift a little bit more than the downside. So it basically did look like positioning for exactly what we got yesterday.
How much are these broad market positions versus individual stock positions? How much is this disparate with respect to betting on the Mag 7 versus the entire market as the economy?
So, I mean, basically, on days like Friday, there's kind of a rush into the super liquid, basically SPX, the biggest ETF. So the single stock volume, although it was very, very high, that kind of takes a back seat on the big days. But, as you said before, the chatter has been about, the concentration of the Mag 7 and kind of, is this sustainable? And most of the commentary is like, this isn't the healthiest moment for the market.
Well, how much do you see that reflected in options, the idea that people are looking for downside risk for some of the high flyers versus upside risk, especially after days that are volatile?
Yeah, I mean, we actually don't see a lot of downside hedging in those single names. That the single name activity, especially the Mag 7, it really has been kind of a story of using options for kind of the leverage and the convexity you get, generally to the upside, just because that's how the market has behaved. And then in the big indexes like SPX, that's where we basically see some of these big structural hedges. Now, CBOE's actually rolling out, hopefully next month, depending on the shutdown, Mag 10 index options, which will actually make it much easier if you did want to do a hedge, basically buying puts in the Mag 10 and selling puts in the S&P to kind of, position for, maybe a little bit of a rebalance in the market.
When it comes to the price action on Friday, is it reminiscent for you of what happened during Trump 1, or are things different this time?
Things seem to be different this time. Trump 1 was crazy at the beginning, and then it got really, really quiet, right? 2017 was the lowest realized and implied volatility we'd seen in decades.
Then blew up in early 18.
Yeah, then things, we got Volmageddon, we got some fireworks towards the end. For the people that I talk to, this definitely is kind of a different moment. It's really interesting with the government shutdown. Things were really quiet at the beginning, right? We just kind of rallied, and then we rallied again, and everybody's like, well, hey, nothing's going to happen, and things are just going to be quiet, and the market, this bull market just keeps trudging higher. There does feel like there's been a shift, maybe in some of the geopolitical issues. It was a little bit of, buy the rumor, sell the fact. Now things are kind of unfolding, and, I don't know, people are not quite ahead of it anymore.
Henry, it's good to see you. Thanks for breaking it down. Henry Schwartz there of CBOE Global Markets. The moves on Friday, the story that Henry was talking about, just speaks to the conditioning of investors over the last year to just buy any weakness off the back of this story.
And frankly, that was all the commentary. When are we going to buy this? And on Monday, it was like, yeah, we're going to do it now. And today we're seeing maybe another round of risk off, but it doesn't feel like a massive sort of cathartic freak out. It just sort of feels like probably should take some chips off the table.
It'll be interesting to see if these moves stick this morning. Down 1% on the S&P, even with fairly decent bank earnings across the board so far.
10 corporate earnings in the United States overwhelm the ongoing uncertainty of a major blow-up between the two biggest economies in the world. And ultimately, that has been the story for this year, and that will be going forward.
Earnings season begins on Wall Street tomorrow. Bank of America and Morgan Stanley. Before we get to tomorrow, later, Chairman Powell at 12:20 Eastern Time. Look out for that reaction from Marvin Lowe of State Street, Jill Ford of Wells Fargo, Alex Altman of Barclays, Christopher Marinac of Jenny Montgomery Scott from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.